kick off the panel, we have several guests that I'd like to start and bring up who have some opening remarks. And I had the pleasure of introducing our first guest speaker last year. She is the chairwoman of the Board of County Supervisors and the proud representative of East County, Diane Jacob.
Thank you, and good morning, everyone. As chairwoman of the San Diego County Board of Supervisors this year, it is my distinct honor and pleasure to kick off the 30th Annual County of San Diego Economic Roundtable. And I want to thank all of you for coming today. It's going to be very exciting. We have a lot of very exciting and skilled and intelligent panelists. This is a very special event. Over its 3 decades, the Roundtable has established itself as the go-to gathering for insight and analysis about the future of our economy. This is where our best and brightest come together. Include yourself in that. Economists, industry experts, and others to offer their thoughts on the year ahead. State of the economy drives our daily lives, how we work, how we live, how we spend, and it also affects what government can and cannot do, depending on tax revenues, building permits, and other factors. At the County of San Diego, we continue our prudent approach to spending and fiscal management. That approach became even more important in the wake of the Great Recession, and it remains central to our decision-making today. Over the past decade, we have used cash when possible to pay for capital projects rather than build up additional debt. This will save taxpayers $1.3 billion in interest payments, and we don't have a linkage fee in the County of San Diego. Thank you. We invest in initiatives that will pay off for taxpayers in the long haul, such as constructing energy-efficient buildings and other facilities. In fact, by lowering its electricity use by nearly 10% in recent years, the county saves taxpayers more than $2 million a year. And since 2002, the county has launched more than 70 capital projects and kept up with major maintenance. New sheriff stations, new libraries, new parks. These projects have created over 20,000 private sector jobs, strengthening our economy and employment market. The county also has managed to come out of the worst part of the Great Recession in sound fiscal shape. We balance our budget. We don't spend more than we take in, so it's no accident that the County of San Diego enjoys a AAA credit rating. So what does this year hold for the county, for the region? Where is our housing market headed? And how will Obamacare affect our lives and our bottom line? These are among the important issues that we'll be discussing today. And I'd like to especially thank our partners in today's event for their efforts to support the region as we move forward in 2014. The San Diego Workforce Partnership, the Union Tribune, San Diego, and the University of San Diego. And since we're here on this beautiful campus, I think it's important to note that USD School of Business has played a prominent role in the overall success of the university. Under the leadership of Dean David Pike, the business school has achieved national prominence, with its evening MBA program being ranked in the nation's top 20 programs by Bloomberg Business Week. That is quite an honor. So I hope you enjoyed today what has now become a 30-year tradition, the San Diego Economic Roundtable. And at this time, I'd like to pass it over to Dean David Pike for a few words. Thank you.
Thank you. And on behalf of the School of Business and University of San Diego, welcome back to the university. I want to thank you, and I've been reminded in the past few days, doing work with Connect and visiting Evo Nexus and talking to people in San Diego, how committed so many people are to this city and this region. And it's been inspiring to listen to people who are devoting so much of their time and energy and talent to make this place better and better. And it's gratifying to be part of that. Higher education, as you know, is a big part of that. We take in students from all over the world, literally educate them, send them all over the world. But you may not be surprised to know that a lot of them want to stay here when they graduate. And so we spend a lot of effort at the university, and I speak specifically of the School of Business, trying to prepare students in unprecedented ways for entry into the real world. So here at USD, they get a very strong liberal arts core. They get trained in ethics and communication and social sciences and the sciences. And then we get them in business and engineering and other majors, and they dive deep into real estate, economics, finance, marketing, etc., in their own majors. And what we're doing at the graduate level, nearly 100% of our graduate students do projects with real-world companies. They're all over the world as we speak in our January intersession, doing projects from Buenos Aires to Shanghai to Dubai. And our undergraduates have increasingly been exposed to real-world projects. From digital marketing class, a social media class where they build websites for local companies, to a marketing class this spring where they're doing a branding exercise with one of the local companies. And right now we have students in Buenos Aires doing work for Walmart Argentina. These are undergraduate students under supervision of faculty. And we have students in Shanghai doing work with WD-40. Last summer, we had students in Istanbul while the riots were going on. I was emailing and texting every 10 minutes, it seemed. Are our students safe? Turns out they all were safe. They were issued gas masks as they walked across the square and had a broad cultural experience in addition to their business training and the value they add. I would like to introduce, I don't know if Chell Roberts. Chell, are you here yet? He is coming, so you should meet him. We have a new, as you know, a new School of Engineering, the Shiley Marcos School of Engineering, and the new dean, Chell Roberts, is here, started in July. You will love to meet him. He is an energetic, creative guy, and engineering has always done great things here, but it's going to be better and better. With that advertisement, I'd like to introduce Peter Karlstrom, who's the president and CEO of the San Diego Workforce Partnership.
Good morning, everybody. At the Workforce Partnership, as many of you know, we fund job training programs throughout the region, which also includes the Career Center Network. There's 13 locations throughout the county, including our 13th, lucky number 13 at the downtown library. So if you haven't seen it, it's up on the 5th floor, and it's sponsored by Bank of America Merrill Lynch, which is really cool because we need to have more private support in order to advance the work that we're doing in our region. In addition, we have an array of youth services, so we're supporting job seekers in the emerging markets and all the way through career. We serve over 25,000 people annually who access our services in different ways. So we have a wide impact throughout the region. But in addition to all the job training programs that we fund, but before I forget, though, there's another 20 to 30 different nonprofits who receive some funding through the Workforce Partnership to do different and targeted job training programs. So we're serving a lot of folks in the region, many who are underserved, many who are the most in need. In addition to that, we do a lot of labor market information and research and publications, many of which you may be aware of. Go to our site, workforce.org. They're all downloadable and free. So check that out. But I would also like just to raise one real important issue that's getting a lot of national attention right now, and that's the extension of unemployment benefits for the long-term unemployed. Congresswoman Susan Davis held a roundtable just earlier this week and invited us, and we brought a couple of job seekers who are soon to lose their long-term unemployment benefits if this is not extended. And both of them, Eugene and Joy, spoke very eloquently about the stress they're facing, the challenges, how hard they're working to try and find work, and they just can't. And having that lifeline of extending the long-term unemployment benefits is just so key. They're close, they're working hard, and we feel we owe it to them in order to keep them going so that they they don't lose their home, that they don't fall further down where they can't get back up. And Susan took that message back to Congress Thursday, and spoke on the floor and shared their story and how important it is to extend the unemployment benefits. If we had Supervisor Jacob there to help with the budget, I think we'd be doing a whole lot better in Congress, but we can't seem to make that match between we know what needs to happen and having to fund that. It's a difficult political issue, but there's a lot of people in need. Our unemployment rate, as you know, has fallen down to, 6.7 locally, but that's not always truly reflective of how many people are truly unemployed, and that number falls when people fall off the other end, when they don't have the long-term support any longer. So there's a lot of people in need. The numbers may look good at times, but there's different ways to measure the unemployment rate, and more work needs to be done. So there's a good conversation going on Twitter. It's #ExtendUI. So check that out if you want to hear more about what's going on and take your position on the debate. So with that, it's my honor to introduce the editor of UT San Diego, Jeff Light. Thank you.
Thank you, Peter. On behalf of the UT, which I dare say is the local newspaper that hears the voices of more economists any week than any paper in the country, it's a pleasure to be associated with this event. We've got great enthusiasm for it, and I'll get us going in just a minute. Probably like me, you're thinking these guys have a terrifically fun job, and I think we'll see a little of that today. The only hazard of making these forecasts is some smart aleck is going to go look and see how they came out, and of course that's what my job is. So. Last year, we asked 8 of our economists to forecast unemployment, GDP growth, inflation, and the Dow Jones Industrial Average. So I went back and looked, and what I found was on unemployment, both local and national, they were super, super close. So really well done there. The inflation guess, I think as the average of the 8 people we had on the panel was almost 2.2%, and that number actually came in super low for the year, like 1.5. And then the GDP growth guess was getting a little more difficult, off by like maybe 100%. and then the Dow, and I think it's actually maybe sort of unfair to ask economists to guess what's going to happen with the Dow, but they had the Dow finishing at 13,725, whereas the actual number was 16,500. So they forecast 12% growth when the growth was 36%. So I'll let you guys do the math on that one. Now, as I looked at this stuff, I thought, there's actually a certain logic to the error here, which we probably don't have time to discuss. And the other thing I thought was, well, geez, I'm going to get up there and throw cold water on everything everybody's going to hear today because we're going to sow doubt. But I actually, as I listen today, I'm going to think about whether the forecast was wrong or maybe it's just a timing issue. Meaning, do these guys really misunderstand the relationship between money supply and inflation? Or will we see inflation up beyond 2.2%? So I'm really looking forward to hear what they have to say. And I think also the relationship between corporate earnings and the stock price is also something where we might see 13,700 this year. So I'm really curious to see what they have to say. So without further ado, let's get going and hear from the people who really know what they're talking about. Diana and Roger, take it away. Thanks a lot. Have a great time today.
Well, we'll give everybody a chance to have a rebuttal to Jeff's comments later. I'm just going to quickly remind you that if you are tweeting this, there is a hashtag, SDEconRound, and I'm going to let Roger go ahead and introduce our first panel.
Thanks, Diana. Just as a historical note, I wanted to say that 30 years ago, President Reagan was in office running for re-election. His whole campaign was based on, it was morning in America. And my question today to the panels is this morning, noon, or night? Anyway, the first panel is going to be about economics. led off by Marnie Cox, the chief economist of the San Diego Association of Governments, and he will be followed by Joseph Crowley from De La Rosa and Company, and he's a specialist in municipal bonds. Finally, we have Alan Jen from the University of San Diego, associate professor of economics and the author of the San Diego Economic Index. So, Marnie, come on up.
Thank you and good morning, and I hope that forward is the one to the right and backwards one to the left. I hope. We'll try it out here. First of all, thank all the sponsors for the opportunity to be here this morning. A real pleasure on our part, 30th annual, and as was mentioned earlier, one of the longest running programs like this of its type. I've been asked to talk about the local economy, but to do that, I thought I'd first bring a little context. And Jeff, you almost stole my thunder, but not quite all of it. First point I thought I'd like to do in terms of context is maybe talk about three categories. What is it that we expected to happen during the year? What was unexpected, which Jeff mentioned a little bit earlier, so I won't go too much into that. But then also what emerging trends are that are coming up that I think we'll probably also be talking about maybe next roundtable. First of all, on the expected side, I think that, first of all, most economists for 2 or 3 years in a row always thought the next year was the breakout year. And so their growth rates were 4 or 5%. And they were always wrong. And so this year they said, okay, we're not being fooled again. It's really 3%. Well, they were closer this time to what it was. So they expected more of the same. And in 2013, it looked like more of the same. Not a lot of breakout in the places where we think it's most important. For example, job growth, wage rate increases, number of hours worked, things like that, which would affect the broad range of people across all income spectrums. The other thing most people thought would happen would that the Fed would begin to unwind its stimulus program. Well, it thought about doing that, and it made those thoughts public in the economy sort of sweltered a little bit at mid-year, so they backed off, and it wasn't until the end of the year before they actually implemented the tapering program or reduction in quantitative easing. And I think, as Lynn Reisner has pointed out, it's sort of removing the training wheels, but I look at it as a little bit different than removing training wheels off the economy. It's sort of making the training wheels a little smaller, right? Just a little bit more confidence, right? So that the economy feels like it's still got some stability there, those wheels on each side of it to keep it from falling, but you've raised up those wheels a little bit so they feel a little more freedom. Not quite completely on its own yet. And the last was rising interest rates really associated with the Fed policy, and sure enough, that's what happened. We've seen interest rates rise, 10-year treasuries, for example, going from about 1.6% in mid-year up to about 3% today. Jeff already talked about the unexpected ones, and he's right, especially the GDP growth at the end of the year, 4% in that third quarter, and then it looks like we're tracking at about 3% in the current quarter, so substantial growth at the end of the year. But at the same time, we're reminded that sometimes GDP growth doesn't end up in the jobs, and so jobs in December were disappointing at about 74,000 when they were running at about 200,000 per month at the national level. Then the emerging trends, I think, first of all, the Federal Reserve has indicated that it's going to unwind its stimulus program. Well, the size of it is $3.1 trillion, and so it's got a lot of unwinding to do. We're in uncharted territory here. We've never done this before, and so the question is what impact will that have on the economy? The Fed has a plan, and so you should have confidence that they have a plan, but they've never tried the plan out before, so we'll see. The other thing is that both the Pope and the 50th anniversary of the War on Poverty brought our attention to income inequality, and I think it's captured here in one of the cartoons. We're always dependent upon those with a good sense of humor to remind us of our humility. But here, income inequality, it means that most of the programs that we've put in place, and they are relatively unprecedented in their size and magnitude, have really not gotten down to where we would like them to be. That is, having a significant impact on what you might say is a second and third quartile of income distribution. It simply has not gotten down there. It's not that the economy hasn't responded. It's not that there are some pieces of the economy that's done well. It just hasn't been broad-based. And the last is labor force participation. And this, I think, is something that has been significant, and I'll talk more about in just a minute. If I was going to choose one chart to talk about what's wrong with the economy at the national level, we're simply performing below trend. There's potential growth, and then there's where we are, actual growth. And the difference here really comes from two categories. First of all, it's kind of the supply side of the economy. We don't have as many people at work today as we did before, so there's fewer oars in the water, right? Pushing that economy forward, simply fewer of them in the water. We have a higher unemployment rate, and last, we have idle capital that's sitting on the sidelines not producing. So that's part of the reason why the economy is not performing up to par. But there's another part too, and that is GDP is typically measured by the production of goods and services in a single year. And we've seen slow growth on the wage side and number of hours worked. So all of us are not receiving wage increases, which would lead to potential consumption increases, which would lead to larger GDP. But the other thing that's happening is that how we got to the level of consumption we're at today. Over the last 10 years before the recession, we were actually consuming a lot more than what we were earning, to the point where the debt to income ratio got to about 140%. So we're consuming 40% more than what we were earning. This was unsustainable. We were borrowing to consume. And then the recession comes along and we start paying down that debt. But for each dollar we're paying down debt, it means we're not consuming. And that has a tendency to depress GDP growth. Also, part of the downturn was a decline in the stock market, decline in the equity in your house. And a lot of people felt uncomfortable not having cushions anymore that they could rely on. So they started saving the old-fashioned way. And for every $100 billion you take out of the stream of consumption and put into saving, its immediate impact is a reduction in net consumption. It doesn't mean that it's not important to the economy, but savings enters into the economy in a different way than construction does, and typically with a lag. So paying down debt and the rise in savings has also impacted that. I'd say that the labor force growth is probably the most problematic of all of the categories that I've mentioned so far. First of all, not only has labor force growth declined broadly by about 4 percentage points, but it's also declined in areas you wouldn't expect it to decline, and that is areas of 25 to 54-year-olds, those that are in their prime working ages. Most economists who have talked about this said, look, it's the post-World War II baby boom population who's retiring, don't worry about it. But that shows that that's not necessarily all the truth. There clearly are people retiring, but there's probably about 5 million people in that 25 to 54-year-old age group who have left the labor force due to frustration. The other way is structural unemployment. And here, the construction industry is a prime example. A lot of job loss in that industry, not a lot of growth on the other side today. And what those construction industry employees are faced with is taking jobs in other industries that don't match up with their skills real well, and as well as what they were being paid with before, structural unemployment. But then there's a whole line, and Peter, I know you were talking about this just prior to it, but there's a lot of disincentives out there today. In our effort to assist the unemployed, we put in programs that when you add them all up, add up to a value of a job of about $50,000. And so if you're a recipient of all of these various programs, unemployment insurance, food stamps, medical care, housing assistance, all of those things, and you're asking yourself, do I go back to work or not? I probably have to find something that pays me equal to what I would be giving up. And so in our effort to assist, We may have gone too far, but by providing assistance provides disincentives. Okay, let's take a look at the San Diego economy. First of all, in terms of job growth over this past year, we're running at about 20,000 job growth rate right now. These are preliminary numbers. The finals are not in yet, and sometimes the final numbers can vary significantly from the preliminary numbers, but it looks like we're running at about 20,000. It's not as good as last year. We had 25,000 job growth, so 20% decline from that, but it's double what we saw in 2011, which was about 10,000 jobs. How are we doing maybe in context with the nation? You can see that this indexes it to 2007, the start of the recession. San Diego's job growth is the blue line, the US is the red line. First of all, the recession was harder hit in San Diego, it was deeper. We lost proportionately more jobs, and the growth out of the recession has been slower. So we're not keeping pace with the nation. Both of us are below past peaks. We still have more jobs we need to add in order to get back above what the past peak was. But both of those look like it's about 1 year's worth of employment growth at current levels. So next year, we should be either up at or past peaks. Not all industries have participated. Last year when I was here, there was only one industry that was higher than its previous peak, and that was the educational health services. We now have added a few more, including government, leisure, and hospitality, or our visitor industry. But there are some other industries still lagging. The one that's hurt the worst and still lagging significantly, as I mentioned earlier, is construction. Per capita income, this is a measure of our standard of living here in the region, and took a dramatic hit during the recession, dropped about 5%. Considering we grow at a maximum about 1% per year, takes a little while to build this back up. But we are building it back up. Next year, we'll be back above where we were before the recession started. Taxable sales, the importance here, probably about 70% of the annual growth in GDP is consumption each year. Taxable retail sales make up a large proportion of that. You can see that that growth I talked about in the 1990s and early 2000s was significant, but we were really consuming more than what we were earning. Along comes a recession, we declined by 3 years, but we begin to pick that back up. Again, not quite back up to where we were prior to the recession. Next year, we should surpass it. One of the trends on that right-hand side of the graph, my right, is the rate of growth coming out of the recession, about an 8% rate of growth, dropping to 7% the following year. This last year, 4.38%. And we're currently tracking at about 3.5% growth. So a little bit slower each year. Maybe not, maybe putting in place something about the year coming up might not be a springboard year for the economy. Housing prices, things have rebounded. You can see from the permits there, we bottomed out at about 3,000 permits. It looks like this year we'll be back up to about 8,000. Still below where we expect to be 10 to 12,000 permits in order to have sufficient housing units being built to accommodate population growth. Housing prices, on the other hand, have come back significantly faster. Looks like home prices this year, according to what I read in the UT, and I know it's a good source, would be about 15+%. But I have some concerns in that housing sector. Let me just put out just a couple of them here. First of all, I think that home price increases are primarily due to low inventory, not demand. I think what's happened is you've seen a lot of cash sales in the marketplace, and those cash sales are sort of the investors getting in, buying a lot of those foreclosed properties, which has increased that sales. As home prices increase, the investor's going to walk away because it no longer looks as good as an investment as it was before, and foreclosures go down, right? Because home prices have gone back up again. So what we're likely to see is less growth in home prices in the coming year, I think, because there won't be sufficient first-time or the move-up market to replace them. One of the other bright spots for San Diego is venture capital. This is really what got the economy going out of the last deep recession we had. But you can see that venture capital funds, although moderately successful here, haven't seen the rates of growth that we saw in the mid and late 1990s, which really got the high-tech, emerging growth technology companies moving forward. One of the other bright spots is our trade with Mexico. Here, we only had one down year at all with the trucks that move through the Otay Mesa border crossing today. There's over $30 billion worth of goods that move both directions, and that was at the depth of the recession. It's had growth each year. Maybe we can talk more about trade during the question and answer, because I think there's some important elements to trade that I think are maybe little known that need to be talked about. Okay, maybe the last point about San Diego is to talk a little bit about population. Historically, San Diego's population used to be tied almost directly to employment growth. So these first set of bars show employment growth over time. The second set show population rates of growth. Somewhere around mid to late 1990s and then beyond, we've seen significant changes where population growth and employment not quite as correlated as what they were in the past. Now, part of the reason for that is because one of the components to population growth is domestic migration. And here you can see beginning in the 1990s, domestic migration, with the exception of a very short period of time in the 2000s, has been negative, meaning that more people move out of San Diego to other parts of the US than move in. And usually these are people within the age group of 24 or 25 to 54. A lot of movement in populations. We've had net out domestic migration, meaning there's fewer people being added to the labor force each year. Typically, those are a function of what's your relative unemployment rate, what's your relative job growth, especially in terms of quality of jobs. People are viewing their opportunities about where they may want to locate, both companies as well as people. And San Diego just simply hasn't been performing the way it had performed in the past, and I think people have voted with their feet. The other part of migration is foreign immigration, pretty standard at about 10,000 people per year, almost oblivious to what happens to jobs. I'm out of time. Thank you for the timekeeper keeping me on track here. You can take a look at my forecast. I run the risk this year. In the past, I always followed the trend that economists normally take is try to be generally right, but now I run the risk of being precisely wrong. So, thank you.
Good morning, everyone. My name is Joe Crowley. I'm a municipal bond research analyst at the firm De La Rosa and Company. De La Rosa and Company is a California-based, California-focused investment bank. Our primary business line is underwriting, trading, marketing California municipal bonds on behalf of our governmental clients and for our institutional investor customers and retail investor customers. My presentation is going to be focused on how the economic trends that were just discussed and will be discussed further in the day impact the state of California and more specifically San Diego area local governments, and this is coming from the perspective of the municipal bond market. As alluded to by Supervisor Jacobs' introduction, that is a very important relationship because it guides and dictates the amount of infrastructure investment that can be accessed, borrowing rates with taxpayers, the burden on taxpayers and in the form of property taxes and sales taxes, et cetera. So a very important element in our economic structure here in California. As far as introduction, I think you're going to see a prevailing trend in these discussions today, but it certainly holds true from the perspective of the municipal bond market. We're seeing a slowly improving economy, which has bolstered state and local government financial outlook, and it's strengthened the credit standing of California municipal bond issuers. Of course, if you're AAA, they don't go higher than that. So even though there is improving trends across the board, Here in San Diego, as I'll get into more detail, that the credit standing of local issuers here is very strong to start with. But just generally across the state, it is an improving outlook. So I think you could safely predict that you're going to see credit stabilization in terms of credit ratings from the three major credit rating agencies, with upgrades outpacing downgrades. Investor sentiment towards California, this would be the state and all of its constituent local governments, is generally positive. This improving economic trend is translating into a stronger perception, stronger demand, greater willingness to borrow at lower rates from investors putting their capital to work. This is especially true for San Diego area credits. Across the board, San Diego enjoys a strong reputation nationally. And it's predicated on a long history of generally strong economic growth and very strong administration and management. There's been some blips across the board, of course, but generally that is the prevailing trend. Okay, so despite this generally positive outlook and environment, there are some significant obstacles and challenges that are in store. It feels better, but by no means could investors or taxpayers or constituents, anyone with a vested interest in the municipal bond market, say that we're safely out of the woods. And the potential traps that exist are in the form of accumulated debt at all levels of government, the obligations that were incurred during the financial crisis as revenues became insufficient to fund programs at existing levels, so there was borrowings and deferrals. Unfunded pensions liabilities, that's widespread nationally, and especially here evident in California. We'll get into some more information about that, as well as retirement health care benefits for retired government workers. On top of that, we talk about the outlook for rising interest rates. That could impose a serious challenge on local governments trying to fund as many programs as they can and projects. And that's also in light of significant infrastructure needs with limited borrowing capacity, given all that accumulated debt that has occurred. Tax reform proposals in Washington, D.C., there could be a serious challenge to local government and our market if there is serious proposals, bipartisan, that may have the impact of the ultimate outcome of eliminating or limiting the exemption of interest income on municipal bonds, which would make local governments have to compete with corporate entities in a taxable, universally taxable interest income world for bonds. So could have the impact of raising borrowing costs. And of course, the implementation of the Affordable Care Act and the unknown consequences that, as of yet, of what the spending requirements would be at the state and the local level. Just a quick snapshot of the market before we kind of get into the more details about credit of the state and San Diego area issuers. This is an overview of the interest rate market through the end of last year and beginning of January 2014. These two charts, MMD is a municipal market data, it's called. It's an index for borrowing interest rates for municipal bonds. So that's how you can track generally the trend and the direction for interest rates in the municipal bond world. But interest rates rose dramatically during the summer of 2013. This was driven by positive economic data. And then further accelerating that trend was in September, the Fed's decision not to taper. It led to a temporary rally in the market. But that was reversed in December when the Fed did announce that it was going to implement some form of tapering, $10 billion per month reduction in bond purchase. MMD has remained stable following the announcement, and on top of that, light supply has also helped to keep the interest rates in very reasonable form for the short term. We'll see how things unfold throughout the rest of the year. Here's trying to track investor sentiment towards our market. Given that the stock market hasn't grown so dramatically recently, you've seen investors getting out of the municipal bond market and going back into equities. The municipal bond market is viewed as a very safe sector. If you're looking for security and your protection of principal, it's a safe haven. So when things are more flush in the economy, and especially measured by the stock market, you'll see outflows, and that's exactly what we've seen. So despite the consensus outlook towards rising interest rates for 2014, which would have the impact of limiting refunding opportunities for local governments, and it would dampen the amount of new net proceeds from new issue bond issues, the current interest rate environment, regardless, still remains attractive. This chart here is tracking the AAA MMD, the San Diego County, if you will, AAA in the interest rate borrowing scale in the red, and the U.S. Treasury scale in blue. A couple notes about this. If you'll note, it's relatively steep, at least steeper than it has been in recent years, and that's just reflecting investors' sentiments that their inflation could be in the offing in the future. And also, I think it's interesting to note that at the long end of the curve, the municipal bond rates are higher than the treasuries. That is historically not what usually occurs, because the municipal bonds have a tax exemption. The interest income is exempt, so you would get a beneficial rate. There should be a spread. But in the current market, municipal bond, the tax exempt rates are higher than the treasury rates at the long end, meaning investors are giving limited value to that exemption at that part of the curve in the current market. The slide here on page 5 is showing what the impact on municipal issuers and the benefit that they have incurred by maintaining strong financials, by maintaining budget discipline, and maintaining strong credit ratings. What's happened since the financial crisis first emerged is that credit spreads between the more highly rated credits and the more lower rated credits has widened out. You benefit, as Supervisor Jacob had mentioned, talking about her the borrowing costs that and the savings that the county has incurred, is directly reflected in in looking at what the difference between a AAA issuer is versus a triple B issuer. Triple B is the lowest investment grade category. There are many amongst us in the world that are just remind me. Later. Is there a tech person that can? Is this? Sorry, I don't see a mouse. Well, I'll just finish up on this slide here as we're. But the point is that for those issuers that have maintained strong credit standing, their borrowing costs have remained very reasonable, very moderate. And as I'm going to get into here shortly, that certainly is held true for San Diego area credits, which have generally across the board strong credit ratings. Thank you. Let's start with the state of California first, then I'll get into some San Diego credits. The outlook for the state has improved dramatically. Over the course of the prior year, the economy is improving, modestly rising employment levels, real estate valuations. The Proposition 30 from 2012 with the increased sales tax rates and personal income tax rates at the upper end of the brackets has strengthened cash flow. So these have all had positive benefits on the operations and the balance sheet and revenue statements of the state of California. But there are significant challenges. The PERS and STRS, unfunded pension liabilities. They have a large amount of debt outstanding, and the deferred payments that they've incurred to schools, as well as Healthcare Reform Act implementation. Just a snapshot of the ratings for the state. I prepared this presentation on Monday. It was out of date as Wednesday. Standard & Poor's on Wednesday upgraded the outlook to positive from stable. So they all are in this single A category, which would seem to be not so bad, but when you also have to put in perspective, it's of the states with general obligation bond ratings, only Illinois has a lower one. It's, the rest of them are all mostly entrenched in the AA category. From the Legislative Analyst's Office, just has done its quick outlook, initial outlook for where we are at right now and where we're going. We're looking at operating surpluses for the current fiscal year, $2.2 billion. That's a major reversal over recent years where we were looking at deficits in the $20 billions of dollars. At current spending levels and trends for the next fiscal year starting July 1, we're looking at a projection of $5.6 billion to the positive. But let's just, as I'm running out of time here myself, I think I'll just give you some of the highlights here. I think the PERS and STRS liabilities, these are the estimates that each of those agencies has published about their funding percentages, which are not in the healthy range, as you could infer. STRS especially. STRS, according to the LAO, would need a $4.5 billion injection of money in the coming fiscal year to reverse its trend, to get it back into stable finances. And you have to put that into perspective, $4.5 billion on a $100 billion operating budget of the general fund. It eats up a lot of money, and it competes with the University of California system and other highly important imperatives. The bullet point in the bottom here, the state has limited borrowing capacity. They're already, for general obligation bonds, they're already spending close to 8% of their annual revenue on bond debt service. That's at the upper range of where they would ever want to be, so it just limits their ability to access the market for other important projects, of which there are many. As we get it, let's make a quick transition to what's going on in San Diego. Credits are very well received, and it's reflecting that San Diego doesn't, the larger issuers do pay-as-you-go projects. They don't rely on the market as well as compared to its peers as much as they do. And it also reflects strong local economy and historically good management practices. Again, some blips along the way, but generally that has been the trend and the reputation the issuers receive. The challenge is federal tax reforms, federal fiscal reforms, state fiscal and economic development reforms. They've done away with redevelopment disillusion, and the policy decisions, programmatic policy decisions in Sacramento regarding criminal justice, health and welfare spending. And when their resources are limited and capped, they have the trend of asking counties and cities to pick up the burden and the cost. And that is always a challenge. As you can see here, I just first of all, I did a comparison of the city of San Diego and the county of San Diego to its peers. And then at the bottom, the table at the bottom of the section just shows San Diego issuers relative some of the bellwether credits. And as you can see, double A's, the county of San Diego, triple A from Standard & Poor's. Important to know that the United States government is AA plus from Standard & Poor's. So San Diego County's got a higher rating than the U.S. government. So you can see that this just reflects, despite what you hear about the news in the press, things are very solid and performing well in San Diego from the bond market's perspective. I am running out of time, so I'll just go through some of these other graphs here, kind of give you some of the key indicators that local governments rely upon for their property and sales tax. These charts all have the same trajectory and curve to them. You can see the downward blips in 2008 with rises, increases coming currently. I think if you look at the city and the county's trends have tracked very closely with declines followed by flat in 2012 and 13, and then nice little pops in the current year. Similarly, Sandag, the trend and trajectory and history was the same. You can look at the downward slide through the recession, and then a pick up to we're at the point here in 2013. We're basically back on track to where we were at the beginning of the decline. The largest property taxpayers, just kind of reflecting a concentration in the high-tech tourism and real estate development sectors in the area. So by and large, and just in conclusion, the outlook for California, for the state and its local governments, especially here in San Diego, is generally positive, improving balance sheets, good income statements, stabilizing credit ratings. The continuing economic trend, however, is subject to highly uncertain variables, which we talked about, continued growth, policy decisions in important areas of healthcare, tax, intergovernmental program funding responsibilities, large amount of unmet infrastructure, large debt burdens, rising interest rate environment. So it feels better, but the environment can change rapidly, as we've always learned. It's very prudent and wise to keep a good fiscal house in order, as San Diego issuers have shown us. Hopefully the state of California can learn something and replicate that as well. Rainy day reserves, limited spending increases reflecting what the near-term environment allows, because the near-term outlook is highly tenuous. So with that, I will conclude. Thank you very much.
Before Alan speaks, I want to remind you that you have cards to write questions down, and we'll pass them on and ask them after this panel's through. So, Alan.
Thank you. I'm pleased to be able to speak today, particularly on the 30th, at the 30th San Diego Economic Roundtable. I recently moved offices here at USD, and digging through my papers, I found this. This is actually the brochure for the 1992 San Diego Economic Roundtable, which is probably then the first one of these that I attended. For those of you who are old timers, George Bailey was the chair of the County Board of Supervisors. Don Bowder of the Union Tribune was the moderator. There was only one person on the panel that day who was here today, and that was Marnie Cox. Joe Bertocchini couldn't be here. He told me he was 13 at the time. But today I'm tasked to speak about the national economy. When we initially set the order for this, I was going to go first, and then we were going to go national, state, and local. But Marnie had a meeting to go to, so we reversed the order. A lot of what I'm going to say he has mentioned. I hope to add a few numbers to what he said and elaborate a little bit more. So I'm going to address the national economic outlook. This chart here shows you the growth rate of GDP. Marnie showed a chart that looks something like this. I'd like to point out that red dashed line here, it's moved up a little bit, but it should be at about 3.5%. That's the long-run average growth rate of the U.S. economy. And that's what economists think is necessary to generate enough jobs to meet the need then of the growing economy. You see that going all the way back to 2000, there have only been a few quarters where we have topped that 3.5% mark. One of those quarters, though, was the third quarter of 2013. You see that we topped 4%. We were at 4.1% in the third quarter. That's the last bar that you see then on this graph. But if you look at the numbers in a little bit more detail, this chart here shows you a breakdown of the components of the GDP. Economists usually break it down into four different parts: personal consumption, gross private domestic investment, government expenditures, and net exports. If you take a look at the last quarter, you see a big reddish-orange section. Okay, that is gross private domestic investment. And normally you would think that would be good because you think that means businesses are buying equipment and building buildings and buying vehicles. But it turns out that a huge part of that was due to inventory accumulation. Inventory accumulation is considered a positive for the quarter in which it's reported. It represents production of goods and services, but it can signal weakness in the future. If inventory is building up, that means that production might be cut back by businesses then in the future. About 1.5% of that 4.1% GDP growth was due to inventory accumulation. So that's a little bit something to look out for in the quarters ahead. This chart here shows you what has happened to the national unemployment rate. Each of these bars represents one monthly change in the national employment situation. And you see that at the depths of the Great Recession, we were losing around 800,000 jobs a month at the national level. All told, during this Great Recession, we ended up losing about almost 9 million jobs. Ever since, say, the beginning of the early 2000s, we've turned to the positive. There was a brief dip when the government laid off a whole bunch of census workers in the summer of 2010, but other than that, we've had positive growth for almost the last 4 years. And if you look at the private sector, there has been positive private sector growth for all those months. All told, we've gained back about 7.6 million of those jobs in the last 46 months. So we're almost there. We've almost gained back all of those jobs that we lost. The problem is that in addition to all those jobs lost, we've had a growing population since, and so we need more job growth in order to drive the unemployment rate down even further. As Marnie indicated, December was disappointing. Only 74,000 jobs added. That's the very low bar that you see there at the end. We need to be, over 200,000. Ideally, we'd be over 300,000 jobs added in terms of the national economy. This is what has this is the results of that on the unemployment rate. You see that we peaked in terms of national unemployment at 10%. We hit 10% exactly. Since then, we've fallen more than 3 full percentage points. The last report in December, reported last Friday, showed that 6.7% is the national unemployment rate. That's better than 10%, but by historic standards, that's still relatively high. So we're on the right trend, but we still got a long way to go. As Marnie indicated, this also masks some distressing trends that we're seeing in terms of the labor market. One thing is the greater underutilization of labor. This chart here shows you different measures of labor underutilization by the Bureau of Labor Statistics. If you download this presentation, I will update it to actually give you the actual values for these U3, U4, U5, U6. The thing that most people follow is the U3. Okay, that is the unemployment rate. You see in green, that is the number of people who are unemployed, 6.7%. Now, to be considered unemployed, you have to be actively looking for work. As Marty indicated, some people have become discouraged. And so the discouraged workers is that reddish-orange section, and those then are the discouraged workers. They make up about 0.5%. And if you add that to the U3, you get the U4, which is at about 7.22%. On top of that, there's another group that is called marginally attached, and they also are sort of in the discouraged worker category. That adds another 0.9%. So to get to the U5, you'd end up with 8.1% of the labor force. And then finally, a third category is this group that is working part-time when they'd rather be working full-time. And that's that huge blue section that you see at the top. It represents about 5% of the labor force. So if you add 5% to the U5, you get the U6. All told, about 13.1% of the labor force is not where they want to be in terms of their employment situation. They either don't have a job or they're working part-time when they'd rather work full-time. The thing is that is better than what it used to be. At the depths of the Great Recession, this was over 17%. So we've improved, but we need more action to drive that down even further. This is a chart that Marnie had. We even used the same source. Federal Reserve Bank of St. Louis shows a labor force participation rate. As Marnie indicated, part of that is due to people discouraged. Part of it's due to the aging population, the baby boomers retiring. Note that this trend, though, has the trend of declining labor force participation has been going on since really about 2000. We reached our peak then at over 67% of the labor force employed, and that's been steadily dropping. There's been, there are a number of factors related to this. One phenomenon that was observed at one point was the fact that the labor force participation rate among males was dropping. In fact, the economists dubbed that the Kramer effect, after the character from Seinfeld, who was walking around with apparently no means of support. Again, that was a trend that was observed in the early 2000s. This is also something that is significant, and it relates to the discussion about long-term unemployment benefits. This is the duration of unemployment. You see that if you look at the duration of unemployment, the number of people who are unemployed for a half a year or more, 27 weeks or more, is a quarter of those unemployed. It's that exploded yellowish segment of the pie there. And so, again, a huge part of the labor force has been out of work for a long time. And so, yes, Marnie indicated that there are some possible disincentives as far as seeking work is concerned. I'd like to point out, though, that right now there's about 2.9 job seekers for every job opening that's out there. So even if you're looking for work, it could be difficult then to find it. And also now there is a stigma against those who are unemployed for long periods. And so employers tend to be biased against hiring them. So if you decide that you're going to try to live off of these benefits and milk them for as long as possible, you run the risk then of having difficulty in the future in terms of getting employment. So what are the problems that are facing the national economy that's sort of keeping the growth rate from being stronger than we would expect? Businesses now are profitable, but hiring is slow. Dow Jones Industrial Average hit a record high last year. Corporate profits are at record levels. But during the Great Recession, companies streamlined their operations all up and down the supply chain, trying to squeeze more productivity then from existing workers. How many of you here have been asked to be more productive, i.e. work longer, harder, whatever? Okay, maybe I think some of you have been. Greater use of temporary and part-time workers. We saw 5% of the workforce part-time when they'd rather be working full-time. Again, this has been occurring for a long time. Companies just trying to cut down in terms of their expenses, in terms of benefits. That has led then to downward pressure on middle and lower income workers. And so a number of factors related to this: technological changes, globalization. A lot of the good middle-class jobs in manufacturing were sent overseas, as it's going to be discussed in the second panel. Good news is some of those jobs then are coming back. Decline in unionization has had an impact in terms of the bargaining power as far as workers are concerned, and then reduced value of the minimum wage. This chart here shows you the real value of the national minimum wage with the latest month, November 2013, as the base. You see that we peaked in terms of the national minimum wage in 1968. At that time, it would have been worth $10.94 in today's dollars. So given the minimum wage of $7.25 national minimum wage, it's lost about a third of its buying power. And in San Diego, the situation is even worse because prices have increased more rapidly. The minimum wage in San Diego was $1.65 in 1968. If it had kept pace with local inflation, it'd now be $13.87. So that the minimum wage, lower income workers, again, their buying power has declined. Marnie mentioned income inequality. It's now at the worst since the 1920s, and everybody's talking about it. Marnie, the winner of the Nobel Prize, Robert Shiller, developer of the Case-Shiller Home Price Index, the president, the Pope. That's probably the first time Marnie and the Pope have been mentioned in the same sentence. But this chart here shows you then the growth rate of income, and you see then that for the sort of the bottom, basically the bottom four categories, it's been relatively stagnant since the 1960s. Whereas in the top two lines, the top 20%, top 5% has seen much larger growth, particularly starting in the 1980s. Okay. That has impacted the economy because it has affected what I would call the virtuous cycle Normally, we'd have this situation. There'd be increased employment. That would lead to increased income, which would lead to increased consumer spending, and therefore investment and hiring. With employment being affected and now income being affected as well, that virtuous cycle has less of an impact. Let's get to the outlook then for the national economy, growing but weakly. I anticipate a GDP growth rate of 3% then for 2014. That would be better than what we had in 2013. The unemployment rate nationally, I expect that to hit 6% in 2014. I'm pleased to say that in this annual forecast by the Econometer that I have actually hit the number correctly 2 years in a row in terms of national forecast. Thank you. Interest rates to increase slightly, but remain relatively low. This chart here shows you what's happened to interest rates. We're anticipating about a 0.5% increase in interest rates by the end of the year. So we expect a 30-year mortgage then, the green line, to hit 5% by the end of the year. Let me mention a little bit something about San Diego to close with. Local economy expected to outpace the national economy. We anticipate job growth of 25,000 locally in 2014. The unemployment rate will outpace the national economy and fall below 6%. Job growth in the areas that have been strong this year, healthcare, administrative and support, leisure and hospitality, and so on. Housing prices will continue to rise due to job growth and relatively low interest rates affecting demand. On the supply side, slower construction. Money showed that permits were up, but that is largely due to construction of multifamily units. Production of single family have been relatively stagnant in the low 2,000 range, where it was more like 10,000 before the downturn. So, but I still anticipate another good year if you're a homeowner, about a double-digit increase in terms of housing prices. To rebut Jeff Light a little bit about the difficulty of economic forecasting, I'm going to cite an Italian then in closing in terms of the difficulty there. Thank you.
Well, we're going to take some questions until about 10 o'clock, and we're actually a little, I think, about 5 minutes ahead of schedule. Roger, you want to kick off, or you want me to start off with I'm going to start off with a muni bond question, because I think they're fascinating, and there are a lot of investors out there, but mine's a really basic question to you, Joseph. You know, you talked about some of the stress points facing muni bond investors. I mean, Detroit filed for bankruptcy, pretty, largest one in history. Pensions, which is huge discussion here in San Diego about what we do with those pensions. And, the Fed, they're going to step off the gas there with the economic stimulus. All of those weighed on people's minds in 2013. I think Morningstar estimated there was like $48.5 billion taken out of muni bond funds. So could you talk to us a little bit about those types of stress points? Like, what do you look for? I mean, if I were an investor, I want to stay far away from bonds. I mean, I look at Detroit, I look at rising interest rates, and I really don't know how quantitative easing, I completely understand how that affects treasuries, but how does that have an effect, spill over into the muni bond market?
There definitely are the significant challenges, and you address a lot of them. Puerto Rico, which accesses the municipal bond market as well, is also on the radar screen as for watching for defaults or potential bankruptcies if they can file it. And then here in California, we have San Bernardino and Stockton that are in the bankruptcy process. So it hasn't been a rosy path recently, and there are major, just continuing that theme, I keep coming back to major obstacles. I think the outlook for the market in this year, for those reasons you highlighted, is not positive from an investor's perspective or from an issuer's perspective. It'll be harder to get transactions effectively placed, efficiently placed, at interest rate levels that would previously have been able to garner. But I think it's a $6 trillion industry in total, and it does, and in each case is different. So despite that there are some major headline risks, there's, I'm not, no way possible to diminish the specter of these challenges, but nonetheless, there is a thriving a marketplace. There always has been, I think, that for deals that need to be done, for good credits, even for some of the lower rated credits, there's going to be market access. So you have to pay for it. You have to work harder to get it if you're an issuer. And as an investor, you're going to have to do your more homework. And that means not only just relying on the rating agencies, but doing your own homework. Because each case is different, and there are good values, and there are good investments, and there are good issuers out there, despite all this, all the other extraneous issues that are going on. So it'll be a difficult year, for certain, but I think that it will still have function effectively.
So just one quick follow-up. If I'm an investor, besides looking at those credit ratings, what else do I need to know? I mean, like, I know San Diego, what their pension obligations are, but just maybe 3 quick tips for people?
I think looking at, the rating agencies always look backwards, so they're looking at audited financial statements. I think look at budgets, look at budget decisions, look at what the outlook is, look at the forward basis for decision making and policy making is. Because I think that you're going to see the issuers that are addressing their challenges, their pension problems, their retiree health programs. Look at those. So budgets, forward-looking documents. I think leading trends, real estate valuations, because property tax is such a big supplier for of revenue for local governments. It's somewhat lagging too. So I think that, to my mind, that is a really effective indicator to look at. And also on the balance sheet, if you're going to look backwards, if you're looking at audited financials, I always go straight to, on the balance sheet, cash. So look on the balance sheet, how much cash has been available, how does that relate to the undesignated fund balances. It provides an indicator of liquidity, flexibility, and ability to withstand downturns and sudden changes. So I think that for a snapshot, those are the key things that I think that are in addition to the rating agency analysis, individual investors taking a look at credits from that perspective.
Alan, the number that struck me in your presentation was the real minimum wage that San Diego should have if it wanted to be at the same level as 1968, $13.87. And there are some suggestions, in Congress to raise it at the federal level, but also at the San Diego level. Should San Diego raise the minimum wage to $14 an hour?
I think San Diego should raise the minimum wage. That would have positive impacts in that it would put more money out into the local economy because people at the lower end tend to spend virtually all of their money. The economic theory, basic economic theory says that the increase in the minimum wage would cause an increase in unemployment, but the economic research recently has not shown that. The results are mixed at best, or at worst, and at best show even some positive benefits to an increase in the minimum wage. Not only do you get more spending power, more macroeconomic impact in terms of consumption, but the workforce tends to be more stable. There tends to be less turnover. Workers become more productive because now there's more to risk. If you're getting paid $13 an hour instead of $8 an hour, you lose your job. That's big. So you tend to be more productive. And the result also is that businesses could raise their prices. That would impact everybody else. But again, given I've done pretty well in the last year, I think I could afford to pay a little bit higher prices.
But in your answer, you sort of imply it's an inflationary impact. Maybe we don't benefit by raising it. What is the balance there?
It is possible that it could lead to an increase in prices. Again, labor costs would increase. There'd be more consumption too, so probably more demand as far as products are concerned. I think that it's been estimated that if McDonald's paid every one of its workers $10.10, that it would increase the price of one of their Big Mac meals by about 68 cents.
I'm going to kind of jump back over, and this could be for Alan or for Joseph. These are a couple of stock market questions. One audience participant is concerned about interest rates rising, and won't most dividend-paying stocks become less attractive, resulting in a decline in many securities in the stock market in general? And kind of on the heels of that, someone else was asking about, and this was a recent Econometer question, the performance of the stock market has led to talk of a bubble. Do you foresee a correction coming in 2014? And what is that? Alan, you might have a leg up on this because that was last week's, but what do you guys think about the interest rates going up, effect on stock market, and correction?
Well, I'll defer to Alan on specifically on the stock market questions. It gets me too far afield. But I think for the interest rate question, I think the fundamentals are leading from Fed policy changes and from economic data. I mean, I think I'm on board with the prevailing trend that you're going to see a rise. Marnie had the modest increase of, I think modestly 50 basis points or so across the yield curve. That could be well within expectations, but I think regardless that is the direction it's going.
In the Econometer, I forecast a 10% increase in the Dow Jones to 17,800 in the coming year. For one thing, in terms of investor psychology, it's almost like investors have now been trained now to buy on dips. So we saw weakness in the stock market the first couple of weeks, but then it has surged upwards again. But the main reason that I'm forecasting that is that we have what some people call a Goldilocks type of economy here. Not too fast, not too slow. We got 3% growth in terms of the GDP. That means that sales for corporations are going to do okay, and it's not rapid enough that the Fed is going to pull back a lot in terms of their policy. So that's why I think that even though interest rates are going to go up, they're going to go up, again, not a huge amount, again, about 0.5% there. One thing helping on that is that Janet Yellen, the new chair of the Fed, is regarded as a dove on interest rates, and so I think she'll hold things back a little bit in terms of the cutting back of the stimulus. And one last thing is that the growth of the stock market in this last year, again, almost 30% on the S&P 500, shows kind of a disconnect now between the stock market and the national economy. It used to be that when the national economy did really well, the stock market did well, and vice versa. It seems now that the stock market does pretty well when the economy is not doing great. Again, it's positive, but not doing great. It used to be said that what was good for General Motors was good for America. Can you say that what's good for Walmart is good for America?
Yeah, go ahead.
I'd like to make a comment about a manufacturing relationship to increase consumption. One of the reasons consumer consumption doesn't have the effect that it used to have is because most of our consumer goods are now produced in China. So we're not creating the jobs that we used to be creating by manufacturing our goods in America. And as far as the disconnect for the stock market, you look at the fact that the companies that make up the Dow and the Standard & Poor's are mainly what I call multinational globalist corporations who are doing well based on their worldwide operations and not necessarily just what's going on in the United States. So that's why we have less of a connection between what's going on with the Dow and the stock exchange and what's really going on in the economy.
Following up on that a little bit, to Alan, one of the questions from the audience says, please address the significant growth in part-time employment as a percentage of the total. Will that trend continue or ebb, and over what time frame?
Unfortunately, I think it will. There was an article this last year in California Management Review where the person, in giving advice to businesses, advocated focusing on what she called the core 20% of your corporation. So in her view, there's a 20% of the corporation is all that is necessary in terms of keeping stability within the company, and then what she advocated then was again, you try to reduce the cost then in terms of the remaining 80%. Again, this is a trend that has been occurring for a long time. It just didn't recently start. So again, part of it has been the rapid rise in terms of healthcare costs. That has the cost of health insurance in particular. So that has just made it really expensive to have full-time benefits-based employees, and so that is something I think that the country has to deal with because we got this growing workforce. You'd like to get them jobs, and particularly jobs that are good paying, and it'll put them then into the middle class. An example, though, of the difficulties that are being faced in terms of job growth is that there was a recent article. And shoot, I just can't remember the company now. Some of you more familiar with technology can help me out here. It was recently bought by Facebook, I think. It's one of these things I think where you upload pictures. Instagram. Thank you. Bought for $1 billion by Facebook. You know how many employees Instagram has? 13, okay? 13. In the article, it compared it to Eastman Kodak, which at its peak, which employed 140,000 employees. And so that's the economy that we're headed towards, is this high-tech, information-based economy generates a lot of money, but the jobs are problematic. And again, that's something that we need to address as an economy and as a society.
So I guess your lesson is, if you're unemployed, start Instagram part 2.
Yeah.
Or Bitcoin. And that one I'm going to toss out. This is sort of, I think, an interesting question that really didn't come out in any of the panel discussions. But the question is the dollar, Federal Reserve, threatened in 2014 by China, Russia, Brazil? And what I think is fascinating is Bitcoin. Whoops, stumped the panel. Anyone?
There was a big discussion about it at an econometer dinner party, and I don't want to say anything.
Okay. Well, let me go ahead.
I'll talk though about the situation with China and so on. Yeah, there's worried that declining value of the dollar, the U.S. economic situation, could lead to future problems as far as the government and its debt financing is concerned, because we're dependent on China and other countries then to buy the U.S. government debt. Well, the deficit is coming down, so there's some improvement as far as that is concerned. The Chinese have indicated, that they have said that they're going to become less dependent on the U.S., but it actually hasn't translated much into actual action. I think when the story of the Great Recession is finally written, the key term that will be used is too big to fail. I think actually the U.S. has become too big to fail compared to China. If they do anything to affect our economy, if we go down, we're taking them with us.
One question here is, Marnie isn't here, but maybe the two of you can talk about it. Why is so much effort being made to increase population here, what with the high unemployment and lack of good paying middle-class jobs, and worse, the limitations of water? So maybe Joseph can talk about it from kind of the municipal
Well, the infrastructure need,
standpoint.
yeah, the population increases. Marty did touch on the migration trends and how it's there's a net of natives born Californians coming out and first generation families moving in. There is a tremendous need on the infrastructure. California, roughly 38 million people now. It has been, the unique thing though, that net, the overall population trend has really stabilized in the last years, and that's economically driven. The opportunity and jobs and to live the California dream over the last few years has been very, very much mitigated. So there, and the employment levels really speak to that. The unemployment rates, historically high, really speak to that too, that the influx that previous generations always noted, they're not occurring right now. So, what is the chicken, their egg, is it desirable? Well, when the economy's booming, it is, but it does put a tremendous impact on our infrastructure. Our water systems are very much strained, especially in these drought conditions. Transportation, our state the highway systems are so overcrowded. Airports, similarly overcrowded. We face tremendous infrastructure needs in California. So that with the weak economy translating into weaker net population gains, it's sort of stabilized. It hasn't made it worse, but it's certainly not getting any better. I mean, I think the overriding factor to the improving it all is a growing job base. Which will have so good economic policy making decisions that will percolate down and create a economy with growing numbers of jobs, will also translate into higher tax revenues and a greater ability to address all our growing infrastructure needs. So I know the question was related about population and net migration. I understand that, but I mean the follow through. Is it beneficial? It has proven to be so for previous generations, but until we get grasp of our economy and our infrastructure needs, it's a problem.
So the second panel that we have will address a little bit of some things beyond the economy, but have a big effect on the economy. Obviously, real estate, healthcare, how we go about developing our communities. Manufacturing, what's going on here in San Diego County with that. So I'm going to have Roger Scholey go ahead and start the introductions on our second panel.
Let's see, our first speaker on panel number 2 is Joe Bertocchini. He's Director of Residential Real Estate at USD's Burnham Moores Center for Real Estate right on campus. So he's going to tell us how much your house is going to go up or whether you can afford to buy next year. Mark Cafferty, President and CEO of the San Diego Regional Economic Development Corp., is going to tell us how we're going to bring in a bunch of companies to San Diego and keep them here and happy. Michelle Nash-Hoff is President of Electrofab Sales, and she's going to give us the inside scoop on San Diego's manufacturing prospects and what we're look forward to ahead. Finally, Julianne R. Howell is the Senior Health Policy Advisor for the county's Health and Human Services Agency, and she will give us her thoughts on the Affordable Care Act and other health issues. So, Joe, please come on up.
Thank you, Roger. You commented earlier about whether you wanted us to indicate whether it's morning, noon, or night. I will tell you all that we have a 4-week-old at home, so for me it's morning and noon, 24 hours a day in our house. So bear with me as I'm still kind of in my baby fog here, but excited to be here today. And this is such a tremendous event, very forward-thinking in nature, and I definitely want to continue that theme here because I know there's a lot of interested people in finding out what's going to happen in the housing market here in 2014. So with that in mind, forward thinking, of course, I want to take a quick step back and go back in time because we have the power to do that now via the magic of the internet. So I went back, and Jeff stole a little bit of my thunder here, but I went back to a few years past and did a little research to see how, as a group, we've done on our forecasts. And that yielded some good and bad news. And before we get to that, though, I want to just take a quick poll of everyone in this room who has been to this event before. Wow, okay. And of all of you who have been here before, how many of you were here in the last 2 years? Okay, good. I'm glad I asked. So here's why. I guess the reason I ask is, if you had been here in January of 2012, you would have heard Ernie Dronenberg talk about what he does as the assessor and recorder and about his future predictions for the years ahead. And for the admission price of $0, I still cannot believe that this is a free event, which is tremendous, and I think we should continue that way. You would have heard Ernie, the very last words he said on the stage were, if you want to buy a home, go out and buy one, because there's never been a better time to do so. So, with that said, if you had gone out in January of 2012 and bought a home and listened to Ernie's sage advice, this is what you would have been rewarded with, which is not too bad in my opinion. I think Ernie gave some pretty good advice there in 2012. So, on a price per square foot basis, we'll get into some more of these stats here. It even almost looks more dramatic there as far as the trend curve there. I bring that up for two reasons. One is, again, I just want to thank everybody who puts this event on, because it's a tremendous event. You get great minds like Ernie who are giving wonderful advice for $0, and that's really a tremendous thing. The other is I just kind of want to set the stage. We've seen a pretty incredible recovery here, so that we can look forward as to what's to come. Now for the bad news, unfortunately, which falls all on my shoulders, as I have to follow Ernie and his prediction and what was going to happen. I'm afraid that I'm going to have a little bit of an unruly mob on my hands if I don't show you 25% price appreciation in 2014, which I'm not a big fan of suspense thrillers. I'll save you the suspense. It's not going to happen in 2014. That's just my prediction. But we are going to see some good growth in the year ahead, and we're going to get to some of those statistics here shortly. So along with this recovery, a lot of the discussion has been surrounding supply and demand and how that's affecting what's going on in the market. A lot of the information that we get, there's a lot of different metrics that we're constantly looking at to try to figure out what's going to happen. And this month's remaining inventory is a big part of what we look at. We get a lot of this information from collateral analytics. And this month's remaining inventory you see, we've denoted here on the right-hand side what indicates a strong normal market. Obviously, anything above 6 months there, more of a sluggish or cooling market. And there's some various ways you can interpret this. Some people say 4 to 8 months is normal. But for the most part, you can see San Diego across the board performing in a really strong way. 0 to 3 months as far as the time frame. And then some of these higher price points at $1.5 million, $1.7 million plus, obviously that's a completely different animal from a price point. And so that's going to behave a little bit differently. But again, for the most part, we're seeing really, really strong market. And as far as a prediction for 2014, I think what we're looking at is a lot of these numbers are going to slightly move up into the next category. So a lot of these numbers that you see in the ones and twos are going to now move into twos and threes and fours. And essentially that's going to be driven by two things. One is the lack of investor money that's really flooding the market that we've seen recently. And I think that's just, as margins thin out here a little bit, we're going to lose a little bit of that, which I think is a good thing for a lot of us in this room. The other is a slight uptick in interest rates. I don't think we need to hold this conference to talk about what we think is going to happen with interest rates. For the most part, I think the general consensus is that they're going to go up. Maybe there's some people in the room who think they're going to go down. I'm not sure. But for the most part, I think those two things are going to lead more towards a trend of more moderation in the market. Okay, so we're going to be seeing a lot less of this and more of this, but gradual growth, which is going to be more sustainable for the long term, which is good for our economy locally. So those are all things we're going to look at. I want to talk about this guy, Mr. Echo Boom, but before I get to that, I want to just, when we talk about supply and demand, there's also something that needs to be talked about in San Diego that's been talked about for a long time, and that's the land shortage that we're faced with here in San Diego. It's becoming quite a problem for us, and specifically for the home builders here in town. And that, combined with the fact that it's getting ever more expensive to build a home in San Diego, is really creating a bit of a problem. And so, you look at these home builders who are out there trying to meet the demand of those who want to buy a home. That's the obvious impact that it has on the market when we don't have the land available. But what's not so obvious is the multiplier effect of the home building industry. And that's, comes in the way of millions of dollars that are pumped back into the local economy by ways of of construction jobs and tax revenues that we're not seeing. And so it's one of those things where for us at the Burnham Moore Center, so much of what I do is focus on residential, and I participate with a lot of the home builders. And it's one of those things where we're always cheerleading the home builders on because they are such a big and important part of our local economy. So if you see a home builder, give them a hug. They need it. So all of those things combined, the lack of for sale, the lack of land, the cost of building homes, all of that has really kind of shifted, and we're seeing more of a movement towards development and redevelopment in these urban cores, vertical development, in addition to the fact that we have this guy, the millennial, Mr. Echo Boom, who is the changing face of the consumer out there in the housing market. So whether he's renting or buying, he has different preferences. And so you look at the statistics on these millennials who are in the market. It's a huge part of the population pie. 80 million Echo Boomers born between 1982 and 1995. They have completely different thought processes than we all have. And I say we, and I know a lot of you are looking at me and I look young, but I'm not a part of this population. So it's, they're delaying these huge life events, getting married, having kids. Those are changing household formation numbers. They're not driving. I remember when I was 16, I rode my bike probably to the DMV to get my driver's license because I wanted to drive. They're not doing that. Walkability is a huge part of their decision-making process. Along with graduating with more debt, is changing their spending habits, and new trends in household structures. This is something that I heard the other day that I thought was really interesting, and that is that we're seeing a new trend where families are coming together, sort of a cohabitation thing, buying homes together, sharing expense of the home, expenses of utilities, nanny services so that the nanny can watch both sets of kids, mom and dad can go out and work. So it's really a changing face of the consumer, which is just incredible. So you talk about all that, you look at the move towards the urban centers, and of course the natural question that comes up that everyone asks is, well, what's going to happen to the single family market then? Is that going to be negatively impacted? And I'll tell you that it is not, and the reason it's not is because of guys like me. This guy up here, I don't know how many of you think like this, but I have a cooler version of myself in my head that I think about sometimes, and this is me. This is the cooler version of myself up here. And so I'll tell you, it's not me. The reality is I'm up here in my suit and tie, and he's got his hoodie on there, and he's looking very cool, and I brought my briefcase to work today, and he's got his messenger bag or backpack or whatever that is, and I drove my terribly unsexy four-door sedan to work today, and he's got his fixie there that he's cruising around town on. So we look at the differences there, and for me, I would love to be this guy. I would love to be in the urban core because it's exciting, it's fun, but my wife constantly reminds me that I am not this guy. Although she thinks I'm very cool, I am not going to be the guy riding around in my suit and tie on my bike. And although it would be great to wear a hoodie every day and maybe get some more street cred with the local barista, I think my boss would probably frown upon me making this presentation in some skinny jeans today. So essentially what I'm getting to is that there are going to be individuals out there in the market that are constantly demanding more out of the single family market. I know for me, we have a 2.5-year-old and a 4-week-old, and we recently moved because we needed more space. We needed a garage, and it was very important to us. We were looking at different school systems, and that was a huge factor when we moved. And so I think there's going to continue to be very strong demand in both these urban populations as well as in the single family market as you go outward from these urban cores. So, sorry, I'm not that cool guy, unfortunately. But here's another statistic that, since I've been involved in real estate, one of the things that I've always watched is expectations and expectations between buyers and sellers, because it's such a huge part of whether or not we can actually make a deal happen. And again, this is a collateral analytics slide that just amazes me. When you look back, you've got the pink line essentially showing the active listings out there in the market, which is essentially the seller's expectation of what their home is worth. Versus this gray line towards the bottom of the sold, or essentially what the reality of the market is, what buyers are paying. And you go back to 2008, 2009, where we all know what was happening. The market was not performing, and these sellers had these huge expectations. And in a normal market, you just see it's completely stagnant. You see no transaction volume because the gap it's what we call the Grand Canyon. They're just too far apart. And so now, and of course, in those days, we had the banks coming in, taking back properties, and they needed to get the assets off the books, so they were, flooding the market. So that's what moved the volatility, not the volatility, but the volume. And so now you can see we've really started to come back together. These numbers and these lines have created a little bit of an equilibrium. They're almost intersecting there, which is a very good sign of a more normal market, a more stabilized market, a more fair market, for lack of a better term. And that's something that we do continue, we will plan on seeing more of in 2014. Again, more stabilization is a good thing for us in the long run. Although we love the price appreciation jumps that we've had, I think a more stable market is something that we all need to be very happy about here in the coming years. So just one more bit of information there. We get there's a lot of talk, about distress in the market and notices of defaults and REO sales and all that. And we all know the numbers, you read them in the paper, but when you stack them up year over year and you take a look at a slide like this, it's just staggering to see where we have been relative to years past with the run-up, where REO sales as a percentage of total sales, in 2008 were better than 50% of what was happening in the market. Just absolutely incredible. So, it's very obvious. You can see the trend is falling. We're getting back to more of normal levels, and that's something that we're going to see continue to fall even further in 2014 till we get back to that 3% in the market, which we're hoping for. So, again, interesting slide there, just as far as from a visual standpoint. Just the incredible market roller coaster we've been on here. So. Moving on here just to this slide, I thought this was interesting just to share with regard to, everyone wants to talk about interest rates and regulation and kind of the changing face of loan structures out there. It's just really interesting to see in years past what loans looked like and what the transaction volume looked like as far as firsts and seconds, and we had HELOCs and all that stuff. Now with regulation coming down, we've got this path that we're on where you're really seeing a lot less of that. And so, you're looking at more traditional first trust deeds on these properties that it's more traditional financing. And I think, again, that's a good thing for the market. So, with regard to interest rates, as much as I would like to get up here and tell you they're going to go up by exactly X percent, I can tell you that there are a lot of people in this room who remember buying their first house and they paid 14% interest rate, 16% interest rate. We go back to last year and the taper tantrum that we had in the middle of the year, and it's just kind of like, I think everyone needs to take a step back and look at the fact that, relatively speaking, we're looking at low interest rates. They are more than likely going to go up, but I don't think that it's really going to have a negative impact on the market. I think that it's just, historically speaking, we're in a very good position on interest rates. And I think that's going to really provide some incentive for people to continue to go out and buy homes. So, that's really about all I wanted to say on interest rates. So, the general trend for 2014 that we're looking at is, price appreciation. This was something that I initially started looking at sales volume for the last 2 years. And in doing so, I got sidetracked because I have ADD. And so, it's one of those things where I started looking at volume in some of these areas. Like Oceanside and Escondido, where the sales volumes were huge. And then I started looking at the actual percentage jumps over the course of 12 months, and it just was staggering. So you look at some of these areas like Escondido at 23.5%, Mira Mesa 18%, Oceanside 17.5%, Chula Vista 16%. Just really incredible movement. Are we going to see this again next year? My prediction is no, we're not. I think we're going to still see some really good positive growth. Probably in that 5 to 7 range. Maybe, I don't know, Alan says maybe 10%, double digits. I have a tendency to defer to Alan because, well, I think we all defer to Alan. So, but anyways, it's one of those things where I think the theme of 2014 is going to be much more normalized, much more stable, and something that's going to be, we'll be able to sustain it for a lot longer than, these incredible swings that we've been seeing for the last couple of years. So, I read the other day there was a researcher that was quoted in the paper from, I think it was from Kiplinger, said the most notable thing about 2014 is going to be how unnotable it is. And I think that is not necessarily a bad thing. I think for us, as reactive a society as we've become, I think to have a nice, normal, stable growth process for the coming year is going to be something that's a warm welcome that we're all looking forward to. So I know there will be more questions about some specifics about the slides, which I'm happy to answer in the Q&A period, but that'll wrap it up for my presentation. So I look forward to answering any questions you have down the road here.
Well, Joe, I think you said you had a 4-week-old at home. I have a 4-year-old at home and a 2-year-old at home, and I want to tell you that baby fog just doesn't wear off. My extremely giddy parents tell me it'll wear off in about 20 years or so, and remind me that it's a little bit of payback. So that was a great presentation, and definitely one of the more comedic presentations I think we've had at the Economic Roundtable over the years. This is a great event, and I love this event for a whole host of reasons. One of them is that I spent the better part of the past 2 decades of my life in workforce development. And whenever I come and I get a chance to stand up here, I get to see the room peppered with an awful lot of the faces that have done that work for decades in San Diego. It is an incredible community, and this event means a lot to that community because, as Peter Kallstrom probably spoke about up front, what you learn here informs what you want to do by way of the programs that you fund in the community, the types of programs that universities create. So not only do I feel it is the best economic forecasting event in San Diego, and I know it's the one that has been around the longest, but I know that both from an economic development perspective and a workforce development perspective, it has tremendous value. So it's an honor, again, to be part of this. I want to just try and do a couple of quick things. You know, Joe had said that I think it was Kiplinger who said this will be a year that's not quite notable, or 2014 would be a year that's not really notable. We're hoping on the economic development side, just the opposite of that for San Diego. And I think the reason why is because for a whole host of reasons, San Diego is sort of as well poised right now to begin promoting itself differently for economic growth. From a financial perspective, the city of San Diego is a more solid place. If you saw Mayor Gloria's State of the City address the other night, I was just about chanting 4 more years for him in the audience. And it was a tremendous State of the City address, and he's been a tremendous leader for our region. Countywide, obviously, we have incredibly solid fiscal leadership at the county. But in addition to that, we also have an economy, as we've seen in Alan Jin's presentations and Marnie's presentations, that nationwide is continuing to grow, and San Diego is continuing to grow in some ways that we see as quite positive. So being able to promote a stable region, being able to promote a region that is continuing to grow, and I think in a lot of ways, being able to promote a region a little bit differently than we have in the past. You know, Roger talked about coming up and talking to all of you about the work of bringing businesses to San Diego. And huge headlines get made. My friend John Horn is in the front audience, and he writes a lot of them. When other folks come to California in this region to try to bring jobs elsewhere, rightfully so. I mean, it's a tried and true economic development strategy led often by heavy-duty political leadership. I'd argue with those folks, going a little bit to the young guy in Joe's presentation, I'd argue that today the more important thing is attracting young talent to your region, retaining talent in your region, and then the businesses will come and grow around that. So I could go anywhere in the nation and spend a lot of the money that our investors give us to convince people that San Diego is a great place to move your business to. But there would be factors that I'm competing against as to why their businesses are elsewhere in the first place that you're never going to change. And we're never going to be a region that's cheaper to do business than a lot of other places. Let's be real, we're in the state of California. We're on the coast of California. There's a lot of reasons why that won't happen. But what we have to do is remind people of the economic anchors that are here in San Diego that are so critical and important to growth. This is just a few words about the EDC. We are only one of several economic development corporations and councils in the region. You all work with a whole host of them. We're partners with all of them. But we look at this region, interestingly these days, as a lot bigger than just the city of San Diego and a lot bigger than just the county of San Diego. But for us, if you look at our mission and our vision, I mean, the things that I would point you to that I'll come back to is global competitiveness. And that's what economic development is really about these days. And then also our region being a magnet for innovation, talent in particular, and investment. And so that's a little bit of what I'll talk about as we kind of go into what we do. Economic development, pretty simple. Attraction, retention, and expansion. That's what it always comes down to. Different strategies for how you do that work. And again, for us in San Diego, our eye is always on economic prosperity for the region and global competitiveness. But this is the region we look at. When we project ourselves as just the city of San Diego, we're this big. You know, the 8th largest city in the country, there's an awful lot to boast about. When we project ourselves as a county, we're much bigger, and we have much more to boast about. When we think about including our partners from Imperial Valley, for certain sectors of the economy, we become much stronger and much more attractive. And when we really start to think of this region without having a border, you really start to think of northern Mexico and Baja as part of this region, you realize that there's almost nothing that cannot happen in this region. You can't think about it, you can't make it, you can't produce it, you can't send it elsewhere, anywhere better than you can from here, if we really think about that as our region. So when we talk about the region, as Richard Florida would say, and I don't know that he coined the phrase, but he has made it very popular, is that we're a mega region. We're an economic mega region, and that is really how we project San Diego and this region to the rest of the world. When we do, we're 6.5 million people, which is quite large. When we do, we have not only 2 major international airports, you also know that we have a lot of smaller airports as well, but 3 land ports of entry and 2 major seaports. And these all give us competitive advantages if we can just think differently about our region. And our peers at the Chamber of Commerce, and probably some of you in the room have been engaged in this, have made huge strides just recently on the construction that needs to be done to speed up our border crossing. So when people tell me what they think the barriers to doing business in Mexico are, they're oftentimes myths, to be quite honest with you. I'm down there monthly, oftentimes weekly, serve on boards in Tijuana. The biggest barrier to us doing the kind of business that we can do in Mexico is how slow it is to get back across that border crossing. And if we can change that, that is something that will be game-changing for this region. You can certainly clap for that. It doesn't get enough attention in the region. A couple of key statistics and characteristics. It's always important for me to remind folks that when I was in the midst of that work at the Workforce Partnership, we were looking at years of sub 4% unemployment in San Diego. So we've come a long way, and Alan and Marnie have kind of shown the charts, and we've seen where unemployment's gone. But as a region, we're not near where we once were. Now, we've got some charts I'll get to in a moment that really shows that at least we have kind of recaptured a lot of what we've lost. But the economy is still growing slowly, and it is very important to project to the rest of the world why people should be thinking about building careers here and building businesses here. Business size breakdown, I won't go into the numbers, and I'm sure that these have been kind of thrown up here earlier in the day, but it is just impossible to miss that we are a small business mecca. San Diego's backbone is small businesses. So again, when people think of economic development or the work of our organization, they think of the Soytecs of the world, the 300, 400 person companies that many of us work collectively to bring to San Diego. What that work usually looks like transactionally, if you spent that time with us at the San Diego Regional EDC, is about a year's worth of work to get an 18-person company to come to San Diego. And they're probably coming because of the biotech sector, or because of the defense sector, or because of the military, or to some degree healthcare or the border, those anchors that continue to bring people to San Diego, not just to visit, but to think about laying roots because of the strengths that we have in those areas. We tend to look at, these are just kind of 3 images, and I know it is never quite accurate for me to say that these are our 3 traded economies, and I note that whenever I'm in a room with, Alan is at least nice about it, Marnie lectures me about it. So, but what we really do have is we have 3 anchors to our economy that we see quite regularly, we spend a lot of time on them, and they are tourism, innovation, and the military. And so for years, a couple of these were sort of ignored on the economic development front. This slide just shows you, and we can get you more data after the presentation, that the reason we focus on those is if you look at the larger pie picture versus the smaller one, you're looking at our region versus the nation percentage-wise, and we are significantly larger in all of those areas than the rest of the nation is. And these are clearly strengths of ours. Some trends we're seeing in San Diego, Michelle will speak about this much better than I can. Probably important to note that right sort of in the middle of that is manufacturing and goods continuing in a downward trend from 1993 to 2012, and there's a whole host of reasons for that. But I think Michelle and I would both say we're at a point in time where that trend could be reversed for a lot of reasons. And it's not, again, because this is the least expensive place to do business, but because there is a large amount of reshoring or onshoring that's sort of happening with the folks who have gone overseas. And again, I would argue that the importance of Mexico being right in our backyard becomes a huge competitive advantage to this happening on both sides of the border. And I don't mean that companies will come here and then just simply do their manufacturing in Mexico. I mean, they'll see, like Taylor Guitars has, that they have an operation here and one in Mexico that can be quite complementary and allow them to really thrive. So going deep into the innovation economy, and again, David has given me the 1-minute wrap-up, so I'm going to start to talk very quickly, which is usually when my Boston accent comes out, so you guys can tell me if that flares up a little bit. So what I'll say is this. One of the things we have to remind people is we have the most diverse innovation economy in the world. I don't mean among the most diverse innovation economies or one of the most diverse innovation economies. I'd argue that you could go anywhere in the world and not find an innovation sector that is as deep in so many different sectors as San Diego is. So biotechnology may get most of the attention in the life sciences, and Qualcomm as a telecommunications provider is obviously the giant for this region in a whole host of ways from economic impact perspective. But when you get into clean technology or the nexus of healthcare and information technology and all of these different things, it's growing in San Diego at a rate, and it spreads across San Diego in a way that gives us a very diverse base of technology industries. And that's a message that we've got to get out to young people, because there's a belief that San Diego may not be a place to come to with a lot of different opportunities for your career as you want to grow it. People may think of 1 or 2 or 3 large companies that they know here and then think that there isn't a deep bench behind that, and we have to remind them that there's an incredibly deep bench, and it crosses over several sectors where their STEM and technical skills are truly needed. And I'm going to really kind of rifle through these right here. So just a little bit about the diversity of that innovation economy. So tourism. Let me just say a couple things about tourism. People usually look at this as a low-wage sector. And there's a lot of talk about that right now as to how much of an economic engine is it really. Well, for us at the EDC, it is unmistakable the number of people who have thought to move a business to San Diego, truly thought to move a business, uproot their family, bring people here, or start a new career here because they first visited. Because they first came to that convention center, they stayed in some of these hotels, they came to visit a friend. It is every day that we notice how much people take notice of San Diego because of tourism. So while you think of the jobs in tourism, think of the economic impact as being much broader. This is our gateway. This is oftentimes, in addition to the military, what brings people to San Diego. And again, the military, I can't say enough, and I'm going to jump to my last slides here because I want to kind of talk about this. And then all of this is available. We'll get it out to you afterwards, or I'm happy to answer some questions. But as we look ahead, you'll see that an awful lot of what's up there is military and defense centric. And that is really the way that we're looking at economic growth and opportunity and even challenges in San Diego in the coming year. Sequestration was not a one-year thing. Got a little bit of headlines and then a lot of headlines, and it sort of cooled off. But over the next 9 years, we'll still be seeing the impacts of those cuts. That was very long-term, draconian base of cuts that, in the president's own words, they threw out there because they figured it would never happen, and now it's happening. And there's been some changes to that are helpful in kind of from where it was initially, but it's still a huge challenge for us. The good news for San Diego is that if you look at the President and the Department of Defense's defense plan for the United States, you'll notice 3 or 4 key things. One is that the future of our military is very much Pacific-facing. You'll hear that term over and over, or a pivot to the Pacific, which geographically positions San Diego quite well for its importance in the future. The 2 things that are called out as among the most important things for the military to be focusing on and investing in the future is cybersecurity and unmanned systems. And San Diego is an epicenter and a center for excellence for both cybersecurity and unmanned systems, with both of those industries growing in San Diego. And then the other thing that we have to think about all the time, and we talk with the military leadership about this, is can we bring more here? Can we consolidate more here? And the answer is yes. We have the capability of bringing more into San Diego, so we are very well positioned for a process that may never be called a BRAC process, but will absolutely be a BRAC-like process for those of you who've seen the region go through the BRAC processes before. Clean tech strengths, and I would say aided by Imperial Valley as our partner on this, continue to be things that I think will draw a lot of interest to San Diego in the coming year. Cannot underestimate the importance of our biotech sector. But I'll end with this, and this will be a little bit of a political statement, and I don't get too political often. But the thing that you have to remember is there's 3 things that businesses are looking for when they're thinking of coming, staying, or growing. And that is an inexpensive business environment to do that. And as I said before, California and San Diego are always going to have their challenges there, and we can argue about it all day long, and we can do things around the margins to make it better, but we'll never be cheaper than the majority of the states and regions in the country. The second thing is the ease of doing business. So the ability for sort of regulation and getting things done and permitting processes to be ones that are seen as efficient and effective, and we have some of the leaders from the city of San Diego and the county in the room that will be focusing on those things. But the last one that is so critical and important is, do we have the workforce that these businesses are going to need to grow? Can we attract it? Can we keep it? And to those of you in the audience in the workforce development community, in the education community, most important of all, can we grow it? Because if we are just a region that continues to attract bright people to come for a little while and not get the young people who are growing up in and around all of that mega region that I just spoke about to realize the opportunities that are here, we will never be the incredible region and the incredible city that we all know that we are and can be in the future. So happy to stick around afterwards and answer specific questions, and thank you for your time as always.
It's a real pleasure to be here today as a panelist instead of just in the audience as I've been for most of the last 20 years. So I'm a manufacturer's rep. I sell manufacturing services. I'm an author of 3 books, and I blog for the Huffington Post Industry Week. So that's why I'm here. So I'm going to talk about some of the trends. Let me see if okay. These are the trends I'm going to cover, about San Diego losing jobs, reshoring, additive manufacturing, training to meet the manufacturing skills, and then about with our innovation. So we lost 5.8 million manufacturing jobs since 2000, and the bottom at 2009. You can see that we finally started upward trend. That represents a little over 500,000 manufacturing jobs that we finally added. Here's a chart that gives it a little bit more perspective of it, of the growth of very, very gradual growth in manufacturing jobs nationwide. Here's what's happened in California. Tremendous job loss in California. We had lost 1.242 million by March of 2013 before we finally started turning up in California. But we are lagging behind the rest of the country. They're at even the rest, so they're at about 4.59% growth, and we're only less than 1% at 0.63 growth, and that means about 8,000 jobs we've created in California. That's pitiful. San Diego, however, is even worse. These are the charts from Kelly Cunningham that he made for National University's Institute of Public Policy. We lost a little over 2,000 more manufacturing jobs last year, mainly because of the effects of sequestration. Many, many companies did not get contracts last year, or very few contracts, no new contracts. The unmanned vehicle industry was the only one that was insulated from losing manufacturing jobs, but all the other defense contractors were down and laid off. There was also some impact on the biomedical companies because of the tax on medical devices that went into effect under the Affordable Care Act. So for the first time, there were actually some medical device companies that lay people off. So those are what's happened. Now, the reshoring. Yes, reshoring has become a trend. When I wrote the first edition of my book and came out in 2009, I actually had a few anecdotal stories of companies coming back from Asia and China in particular, mainly because of very egregious quality problems, but it was just a story here and a story there and a story here. I had like about 6 case studies in my book of San Diego companies that had come back. But in 2010, Harry Mosier, former CEO of a large equipment company, founded the Reshoring Initiative. It is a 501c3 now. The goal was to change the mindset from offshore is cheaper to local reduces the total cost of ownership. And purpose was to train original equipment manufacturers and suppliers on why to source local and how to use his total cost of ownership spreadsheet that he developed that even included calculations for the hidden costs of doing business offshore and also the risk factors, such as political risk, intellectual property theft. So this worksheet now is able to calculate all those hidden costs. So this is provided free online at reshorenow.org. So according to the Reshoring Initiative, I got these figures from Harry at the end of last year. Oh, Harry and I had gotten connected because I had already a section in my book that came out in 2009 on why it was important to understand total cost of ownership. So when I started blogging in April 2010, which was the same month Harry started the Reshoring Initiative, he was the first person to sign up on my blog. And then we got connected when I came out with an article on why it was important to understand total cost of ownership. So he's trained me in his worksheet, and I'm his authorized West Coast speaker for the Reshoring Initiative at trade shows and conferences. So the calculations and the case studies that they've been collecting over the last nearly 4 years now is in 2003 we had a really high rate of offshoring, about 150,000 jobs per year. Now in 2013 it dropped down to about 30 to 50,000, so that's about a 70% drop. New reshoring is now only very low, and new reshoring in 2013 is really increasing. So of this job growth of 500,000 some jobs, they're estimating about 80,000 jobs nationwide are because of reshoring, which is about a 15% total. So additive manufacturing is the next thing. It's hailed by the economists as the catalyst of the third industrial revolution. It's projected to have a significant impact on manufacturing in the near future. And this is because you can suddenly be able to make finished, usable parts in a rapid way without any cost of tooling. It is where you're building a part up from the bottom up in layers. And currently only about 28% of the money spent on printing things is for final products, but this is predicted to rise about 50% by 2016 and 80% by 2020. Most of the design, engineering, and product development companies in San Diego now have at least one machine, but we have a service bureau in Poway Solid Concepts that has every kind of machine that is made that you can do. And here's some, so there's many different ways. You can now make even metal parts using this rapid additive manufacturing, except for aluminum. It's limited right now to ferrous metals and titanium. So because of the increase of the baby boomers retiring and the fact that new generations, subsequent generations didn't get into manufacturing, we have a shortage of about 600,000 skilled workers nationwide. This means people that have specific skills needed in manufacturing. So we're now having about 10,000 a day retire of baby boomers since 2011. So we are really need to focus on training for manufacturing jobs or retraining some of these college graduates that have degrees that they can't find jobs to do what they've been trained to do. So many people were geared to going to four-year colleges, and they got degrees in things that aren't relevant for getting jobs today. So we could do a lot of retraining. And we are fortunate in San Diego to have more facilities that can train for manufacturing skills than any other part of the country I have researched. We have the San Diego City College where you can learn machining skills, free career technical education at the Continuing Education Center for Welding, Metal Fab, and Miramar College has training for the biotech and medical industry. Miracosta College also implemented machining training 2 years ago. San Pasqual High School and Chaparral High School now have 2-year training programs for manufacturing jobs. And one of the largest machining companies is starting next month a training program and an apprenticeship program, Quality Controlled Manufacturing. Workshop for Warriors is training veterans in manufacturing skills. So that's, we have all these capable. Now, as far as the innovation is concerned, I'm on the steering committee of the San Diego Inventors Forum for almost 5 years now, and we have had standing room only for 4 of the 5 years before we moved to a larger facility last year. And we have a lot of innovation. The difference is when I first started going to the meetings, we had a lot of serial inventors, I would call, that had actually started companies, were inventing products, and then maybe were on their second generation or third generation of new products. What's changed in the last couple of years is we have more people that are coming and not starting companies, but wanting to license their technology, and they need help to be able to do this. We have some excellent resources for helping people get started that are forming teams and companies through the Connect Springboard program, and also the UCSD Jacobs School of Engineering von Liebig Entrepreneurism Center, and then the incubator for telecommunications company EvoNexus, funded by ComNexus. So we need now help in starting these companies for licensing their technology, a lot of creative breakthrough technology. San Diego's really a startup area of a lot of startup companies. That's traditionally what we have been. And then companies grow to a certain level, and as long as they're privately owned, they stay here in San Diego. When they get to a certain level and they go public, then they get to be targets for acquisition, and when they're acquired, many times they're moved out of San Diego. And that is historically true for the more than 30 years I've been in the manufacturing industry. So that's so my outlook for 2014 is more reshoring taking place, more manufacturing jobs, more people getting trained for manufacturing jobs through these programs, an increase in opportunities for new products through this additive manufacturing. The negatives are the fact that we are supposed to have an easing of the sequestration funding because of the defense budget, but last week, to fund the extended unemployment benefits, the Democrats proposed that full implementation of sequestration would be a way to pay for the extending the unemployment benefits. So that could hurt our defense and military industry if that full, really draconian cuts to our military and defense would be reinstated, because right now every defense contractor is more positive about being able to get business this year, and that would really hurt them. So that's one of the negatives. The other negative is nobody knows what the economic cost is going to be to comply with the employer mandate of the Affordable Care Act. So everybody is holding off on hiring until they have a better feel of how this is going to impact their bottom line. And that leads right into our next speaker.
Well, last but not least, we are going to talk about health reform, which is quite a challenge in 10 minutes. But what I'm going to try to do is give you a feeling in a kind of broad overview of the many facets of the Affordable Care Act, and also talk about some evidence of that here in San Diego. That worked. All right. Something that many people are not aware of is that the Affordable Care Act is more than just insurance reform. There are many facets of it that also deal with health system reform, public health, and I want to touch at least briefly on all of this stuff. So on the insurance reform side, the intent has been to expand coverage, improve benefits and protections, increase affordability, create insurance exchanges, and expand Medicaid, a key piece of getting coverage for everyone. On the system reform side, the intent is to improve quality and value. Kind of the buzz term is we want to pay for value, not volume. I'll get closer, thank you. To create new delivery and financing models, further develop the workforce, fits in very nicely on the economic development side, improve care coordination, and focus finally on prevention, public health, wellness, the true sources of health in individuals in the population more broadly. The goal for all of these efforts is what's been characterized as the triple aim. We want better health for the population, better care for individuals, and at lower cost per capita. And notice I didn't say lower total cost. That's not possible. We've got a growing population, an aging population. but it's recognized that a lot of our expenditures really are wasteful, that we can save quite a bit, and with these new efforts, achieve lower cost per capita. All right. Turning to some of the insurance improvements. One of the first things that was implemented when the ACA passed was to enable adult children to remain on their parents' insurance until age 26. We now have what is as of January 1st, 2014, what has been called guaranteed issue. It means no longer can you be denied insurance for a pre-existing condition. Very important for many, many people with chronic conditions in this country, a huge fraction of our population. We've now specified essential health benefits, a core set of benefits that must be included in all insurance. And importantly, that includes mental health, behavioral health, and substance use, which historically have been very poorly covered compared to the sort of traditional medical surgical benefits. The mind-body dichotomy has existed far too long, but it's fully appreciated, finally, that these are essential components of comprehensive coverage. There are no longer any annual or lifetime cost limits that an insurance policy will cover. Historically, people ran up in a year, the ceiling for their coverage, or over the lifetime. If you get cancer and you need some of the innovative therapies, it can cost millions. Now that must be covered by insurance. There are cost limits on what your out-of-pocket costs are per year, so that's a little bit confusing on that bullet. Rates now are no longer based on health status. In other words, if you have a pre-existing condition, there isn't medical underwriting that's going to change your premium as a function of that. And it's not based on gender either. Being a woman is no longer a pre-existing condition for the purpose of your insurance policy, okay? So there are 3 age categories. Family size determines the premium. Geographic location, because there's huge variation by geography, and the particular benefit structure in terms of who the providers are and so forth, which should be one more dash there. Finally, there's a consistent criterion for determining eligibility for Medicaid and also for subsidies. That's called Modified Adjusted Gross Income, or MAGI, which you probably have heard or will heard. All right. A key piece of the Affordable Care Act is expanding Medicaid eligibility. Since the founding of the Medicaid program back in the mid-60s, it was a program designed to cover certain categories of people: children, pregnant women, low-income seniors. Now, Medicaid is intended to be based purely on your income level. If you have an income less than 138% of the federal poverty level, you qualify for Medicaid, at least if you're in a state that expanded Medicaid, as California has. So this sort of symbolically is there's now a complete umbrella, not just a partial one. The main category of people who have been included, who historically were excluded, are childless adults. In California, all of this translates into expanded Medi-Cal and the availability of our own health insurance marketplace, Covered California. Under Medi-Cal, this has now been expanded to childless adults. Income determines eligibility. There is no longer an asset test, except if you need long-term care. And it's expected that 1 in 6 San Diegans are eligible and will be on Medi-Cal, up from 1 in 8. On the Covered California side, that was the first marketplace to get launched. It has been very successful. It's had a few technological glitches, but nothing like healthcare.gov, and many, many, many people are getting coverage through it. There is premium assistance available based on income and family size, and 1 in 9 San Diegans hopefully will purchase through Covered California. This graphic shows you the number of people projected statewide to qualify for premium assistance on the exchange. Here in San Diego, 190,000 people. As an example, an individual with income up to $46,000 can qualify for advanced premium tax credits, which is the way the subsidy is provided. A family of 4 up to $94,000 qualifies for subsidies. So this is really a tremendous assistance to the middle class. There are 12 plans that have been approved to sell on Covered California. We are what is called an active insurer or active purchaser in the state. Not every state is. We have a very strong Department of Insurance that makes sure that we've got financially viable companies that are offering on the exchange, the networks are appropriate, and so forth. 6 of these companies sell in San Diego: Anthem Blue Cross, Blue Shield, Kaiser, HealthNet, Sharp Healthcare, and Molina. So in my remaining very few minutes, I want to quickly talk about the delivery system transformation that's evidence here in San Diego, and a little bit about public health. So Sharp Healthcare is one of the 30 pioneer affordable care organizations in the country, taking responsibility for a defined population, bringing physicians and hospitals and long-term care together so you have more integrated care. The San Diego Care Transitions Partnership is one of 100 programs, the largest in the country, that's trying to improve care transitions for fee-for-service Medicare beneficiaries. Right now, about 25% of people discharged from the hospital with fee-for-service Medicare get readmitted in 30 days. That's ridiculous, bad for everybody. This is an effort to have more coordinated care, bring that rate down. And the Coordinated Care Initiative, CalMeta Connect, is geared toward providing more integrated care for low-income seniors and people with disabilities. On the prevention and public health side, the ACA, for the first time, required a national prevention strategy, has dedicated funding for prevention and public health, has provided funding for community transformation grants, of which San Diego has one. And this gives you a sort of quick array of some of the initiatives that have been created through the combination of funding from communities putting prevention to work and the community transformation grant. So everything from increasing farmers markets to working in schools so that there's increased physical activity and better nutrition, to working with SANDAG so that health considerations influence land use and transportation. What a novel idea. Here in San Diego, we're fortunate to have our own Live Well San Diego, which is an initiative that's been launched by the county but embraced broadly across many sectors of the community. The Board of Supervisors approved Building Better Health in July of 2010, shortly after the passage of the Affordable Care Act. Living Safely was approved in 2012 because you've got to have safe neighborhoods if you're going to be able to get out and exercise. And Thriving, the key piece of health and wellness, economic development, is the piece that we're working on right now. So that in a nutshell, we're fortunate to have the Affordable Care Act, and it has many positive benefits here in San Diego.
Okay, just a couple of reminders before we go into a longer Q&A session. The presentations, again, they're going to be posted online at sdcounty.ca.gov/economic roundtable. All of that's listed up on that screen. And we'd like people to fill out the yellow evaluation sheets before you leave. There'll be people to collect those as you leave out the door. Those are very helpful to give us feedback on how we've done during the presentations. I'm going to go ahead and kick off with a housing question from one of our members in the audience. And so this could go to really a couple different people on here. But the question really looks at the what this audience member is called artificial government policy restrictions of foreclosed foreclosed housing sales and cash investors have increased pricing above nominal consumer demand. So the gist of this question is, has this caused a housing bubble? And will we see a price decline in the near future as the stimulus is taken away and the cash buyers go away?
Good question. I think with regard to the investors leaving the market, I mean, it's like any other investment pool. You've got an incredible opportunity that's been out there for a number of years, and now that the margins are waning for those investors, you're going to see those investors walk with their profits. And so, with regard to a bubble, no, I don't think there's necessarily a bubble. I think we are going to see some stabilizing of growth, so you won't see such incredible upswings. But you are certainly going to see some investor cash that is not going to be quite as strong in the market in the year ahead. So I think that's probably a good outlook. As I mentioned in my presentation, it's been really tough for a lot of people that are out there. Myself personally, we bought a home not long ago, and it was something where I think a lot of people were struggling out there trying to find a house, just being the average Joe, on the street trying to buy a house when you've got to compete with 20 other people who are in the pool, who have all cash. And granted, that's the smart money has been preparing for this. And so, you have to give them credit for that. But at the same time, it really does hurt those of us that are out there in the street trying to just buy a home to improve our lives for our families. So hopefully that answers the question.
Well, I was going to follow up, and maybe Alan can address this, don't you suppose that the investors are going to unload their investments in the next couple of years, and that'll increase inventories and then put a lid on price pressure?
It's possible. Again, as Joan indicated, I think all trends will eventually level off here as interest rates rise. That's going to price some people out of the market. I think one thing that we're going to see, though, is that as the economy recovers a little bit more, you're going to get a little bit of unwinding of certain situations. For example, the doubling up in terms of housing units, kids moving away from their parents' residence, and I think that'll increase the demand for housing all up and down the structure. It'll start off at the rental level, but eventually translate into the single-family market as well.
And Mark, you didn't address this too much in your presentation, but housing costs have always been a problem for people wanting to move to San Diego and attracting talent here. What do you want to say about housing and the economic development connection?
Absolutely right. It's critical. I mean, I think it's interesting right now. I said I was going to make a political statement, and then I think I forgot my political statement when I was closing with you guys. And the political statement was going to be around the fact that, right now we have a linkage fee in the city of San Diego that's getting tacked on to development. And right or wrong, however you feel about it, the thought process is that as jobs get created and businesses expand and grow, those new jobs somehow are contributing to the affordable housing challenges that we have in San Diego. I think the thing that everybody's going to wrap their mind around is that linkage fee is focused on actually subsidized housing, housing for the people who have the most challenges and barriers to finding housing right now. It's not actually something that's addressing the broader housing affordability issue that I actually think impacts all industries. And I can stand up here and say we have to attract the best and brightest. We have to, grow our workforce and keep those folks here. But if they can't afford to live here, there are some amazing regions around the country where you can do great work, you can have a great quality of life, and you can get a lot more for your money than you can in San Diego. I don't know what the answer is, Roger. I mean, I know it's a factor that we have to deal with every day. When businesses are thinking of coming here, and they're really thinking of coming here, they've made that decision, the quality of schools, the quality of healthcare, and the affordability of homes are the three things that could become the factors that make them decide to come or not. And if you're extremely wealthy, San Diego is a great place to come to. If you are somebody who, let's even say, is making a great means $100,000 a year, and you're coming in for an engineering position. The challenge is, what does $100,000 a year do for you in San Diego versus what can it do for you in Raleigh-Durham and the Research Triangle and places around the country right now that are competing for that same talent? I think the only way we address this is we have got to get a lot of minds together around broad-based solutions for the county and not continue to think, and this will be my political message, that if we just tack fees onto business, that will help us generate the money that we need to kind of address some of the issues that we've got in the city and the county.
One thing that may prop the market up is our construction infrastructure. In San Diego County, employment in construction reached its peak in June of 2006 when there were about 95,000 people working in construction. At the depths of the Great Recession, we had lost 40,000 of those jobs. So 40% of construction workers, went into other business or left the region. We've gained some of them back, but only a couple of thousand. And so I foresee a possible bottleneck in the next few years in terms of housing construction. And again, if you look at the permitting data the last few years, we've only built about 2,000 new single-family units a year compared to about 10,000 before the downturn.
I'm going to switch over to a question that probably could go to either Mark or Michelle, but one audience member wonders, if veterans were to seek business ownership, what top 3 sectors of the mega region in Southern California would be named for veteran-owned business entrepreneurship? And then I would broaden that to say, just in particular for anyone looking to start business, what 3 sectors would you recommend?
I would recommend clean tech. That's a lower cost to get into. And I think clean tech is one of our really burgeoning industrial sectors. We have a very strong action sports industry, and maybe some veterans that there's ideas for products that would both benefit people that are involved in sports and also veterans that come back with some kind of some disability. So those are 2 of the things I can think of.
Yeah, I would add just a few more. I mean, I think it seems like an obvious one, but I would say that the defense sector in San Diego, which is, again, more broad and diverse than I think most folks realize, things like security clearances that those people already have, the need for so many of the businesses that are doing a larger portion of work to be working with small businesses, the benefits of having a veteran-owned business, things of that nature. But I think, in particular, as the unmanned systems sector grows in San Diego, controversially grows in San Diego, it's going to become a sector that probably has more impact on our lives by way of agriculture, science, search and rescue, firefighting than it will military capacity. In fact, I think that capacity will soon be reached, and we'll see it actually broadening a great bit as it is already. But getting into that sector will allow folks to actually get quite entrepreneurial with, I think, continuing to do that work. The second thing I would say, it doesn't sound like an entrepreneurial sector for veterans to think about getting into, but healthcare. During the Great Recession, the one thing that probably was positive for some healthcare providers in that sector was it actually did away with the nursing shortage that they all knew that they were going to be getting. So I spent years telling people, study nursing, a job's going to be there, and then suddenly none of the nurses retired. Very real issue across the country. Those nurses are retiring. The retirements in healthcare are significant. The growth of healthcare, because of the need for care and the quality of care, aging workforce, changes in healthcare, that's an industry that I think, again, we need to think about how do we cross-train our veterans. We've got a lot of folks with great healthcare capacity in the military, but we're losing way too many veterans immediately to their home of record, wherever it may be, because we as a community aren't doing a good enough job of telling them sort of what's available to them here in San Diego, and I think collectively we've got to promote that better.
Education is a key thing, though, because right now there's already been like a 1 and 2 year waiting list to get into any new nursing program here in San Diego. So that's one thing. There's not enough nursing instructors is one of the problems, as well as the budget cuts at the state education level, not funding more nursing programs. So.
I think, just with regard to real estate as an industry, I'm not sure, we put on, the Burnham Moore Center puts on a number of conferences every year, and more often than not, we have some of our scholarship winners there to make presentations about their path in life. And and what they've gone through, which usually involves going through the MSRE program, the Master's Science in Real Estate program at the Burnham Moore Center. And what we've noticed lately, or as you may have seen, is we have a few active service members who are either in our full part-time program, have been presenting at some of these conferences, and we've really seen a lot of outreach from the real estate community. A couple of it specifically with these active SEAL, the SEAL community has really become very interested in getting involved in real estate, and we've seen a lot of outreach from the real estate industry back to the SEAL community and back to the military, which has been really great. So we're actually, in this new year, one of the initiatives that we're really taking on is trying to figure out a way to bridge that gap to bring those two parties together, because it's something that I think a lot of people are having a hard time with transitioning out of one portion of their life and into the next chapter. And so we want to do what we can to help them, because they've done so much for us. So
I am going to kind of switch over, and this is something for either, I think, well, Julianne especially, or maybe Alan, but one audience member wonders, what would be the effect on local private industry of a change of the healthcare system to a single payer or government option system?
We could talk about, is this on?
Is that working?
They turn it on.
They'll turn it on. We could spend a lot of time talking about that, but I think the reality in this country is we are not going to go to single payer. I spent about 6 years actually working with the Centers for Medicare and Medicaid Services in DC recently, and it's not realistic to think that the government could manage the whole of the financial side of things. And I can tell you, I don't say that from a philosophical perspective. I think it is simply the reality of this country right now. There's too much that's politically tied up around fee-for-service and how you reimburse different providers and so forth. And as much as people are not thrilled about for-profit insurance companies, who are an incredibly important part of the way that we have the infrastructure of our system, they have more capability to be innovative, to try out new things than the government does. And that is particularly true right now when you've got such gridlock in Washington. So it's not an issue of philosophically, I think it's realistically, we are not going to single payer anytime soon.
Alan, you're nodding. Do you want to add anything to that?
I would agree that it's not politically viable right now, but economists look at a phenomenon that has been called job lock, and that is a result of healthcare coverage for a lot of people being tied to their jobs. Because of that, there is less mobility in the labor market. People are more afraid to change jobs or to go out on their own and start businesses, because oftentimes their health care is tied to their employment, and that has a little bit of distorting effect on the labor market.
But that problem has been solved by the Affordable Care Act. I cannot stress that enough. In any state now, you can go to the insurance exchange as an individual and buy insurance. And if your income is low enough, you can get subsidies to support your purchase of the insurance. But irrespective of income, you can now go purchase a policy that will cover you and cover your family. So that lock to your employer is one of the most important things that has changed now with the Affordable Care Act.
So there may be that's cleared up, the lock to the employer, but what we hear a lot are from small businesses and companies who do not want to hire or want to wait to see what the effects of this Affordable Care Act will be. There's questions about fines and fees, and there's a lot of uncertainty. Michelle, do you have something to say about what you're seeing in manufacturing?
Well, manufacturers have really sort of had their head in the sand and not really, knew where to get the information. So just this year, or actually at the end of last year, we're starting to have some forums about it, like connects small to medium enterprise group. Operations Roundtable is having a forum in February, but nobody's really knows, and there's not a lot of consultants you can consult with to get the answers. So that's a real problem.
And I think part of that is that, the employer mandate was delayed a year by the Obama administration because it's been difficult enough to get the insurance exchanges launched and to get the expansion of Medicaid achieved. And the complexity in this country around financing healthcare is extraordinary. I mean, if we went to a single-payer system, it would not be nearly this complex, but that's not the American way. So the regulations that are going to specify exactly what's involved in the employer mandate and where it applies and where it doesn't and so forth are still being developed. The challenge is healthcare in this country is more expensive than it is anywhere else in the world. And so if you're going to have guaranteed issue, if we want to assure that everybody can get insured, including people who really need it, because if you have a chronic condition, you need to be covered, that costs money. You're going to pay for it either in taxes, which we don't like, or in an array of fees and other arrangements. The reason that there is an individual mandate is because you need, in insurance, a broad pool. You need people who are healthy as well as people who are sick. If everybody who's in the insurance pool is sick, then you get into what's called a death spiral, and it gets too expensive for everybody. So what we're struggling with as a country is how to spread out the costs of making it possible for everybody to be covered. And there are winners and losers in that. There is no way to achieve it any other way. That's kind of the reality.
Well, one of the audience members asked a question relevant to all that, and maybe you and Mark can address this, and that is this issue of employers having disincentive to adding more workers because they get over the 50-person or the 30-person threshold, and they say it's too expensive to grow. And I thought, well, if you're going to grow and be profitable, that would be a minor element, but perhaps that's not so true. So can you both tell us about that conundrum?
Well, I am personally familiar with the large insurance pool market. I mean, I worked for the University of California for many years. And, large employers have the ability to self-insure and to create, benefits for their large workforce at lower cost. And I can tell you, just looking at the premium that you pay under a large employer versus what you pay single, in small group or as an individual, there's still huge gaps. So the small group, the small business, which is so characteristic of San Diego, I appreciate is kind of the most difficult to play, if you will. It's also the part that we have the least experience with so far, the small insurance market. And we have it open in San Diego and in California more broadly right now. But there's not yet been a lot of attention to it because the focus has been on getting the exchange up and running for the individual market. So I think these are things that are going to play out over the next couple of years. And as much as we'd like it to happen faster, this is complex, and I think it's going about as fast as it can right now. So I appreciate the uncertainty, and I wish I could tell you, here's what to do, but we don't know yet, okay?
And I mean, Alan may disagree with this, or I'm curious if he agrees with it or disagrees with it, but I think, Michelle just touched on it when she said, manufacturers had their head in the sands. I think there's just so much happening right now that businesses have to think about when they're thinking about adding workers. So if you're doing great and you have to add workers, I mean, that's an easy decision to make. But you're looking, we're in an economic recovery that is not a juggernaut by any stretch. So people don't know if it's real, and they hear about sort of the easing back of what could happen with the government, and is that going to change some things? The complexities of understanding and kind of knowing how the Affordable Care Act and its various elements will or won't impact your business, kind of based on your size. increased water rates, increased energy rates. Other things are kind of all coming at a time where I think, when we look at that unemployment rate, still, not as low as we would all love to see it. I think it's because all these factors are in the heads of business owners and people who have to make those decisions. And I think the miscommunication or just like the fire hose of stuff that's coming at them is what's really stunting economic growth and keeping us from seeing that unemployment rate drop right now. I don't know if Alan would agree or disagree with it. It's more anecdotal for me because we meet with business after business and have the discussions. We don't study it deeply. But this issue comes up all the time in exactly the way that Michelle talked about, which is I think some folks saw the Affordable Care Act come out of the gate so catastrophically almost, to some degree, that I think some of them thought it might just go away. With what was happening, and now obviously it's not, and it's here, and people have to begin to comply.
One of the other factors is most people don't realize that 96% of all manufacturers are under 100 people in California, and even a higher, over 90% are still under 50 people. So this is really, different. And that affects a lot of different policies because, unfortunately, we have legislators in the state that seem to think that all business is big business with deep pockets, and they do not realize the nature of our small business California, especially for manufacturers, and they're continually passing regulations and things that add to the cost of manufacturers, which is one of our big drivers for driving manufacturers out of California and why we're sort of pray for government like Governor Perry to come and pick off California companies to move to Texas.
Well, this is a question that I think all of you can talk about because as you all touched on this question, and it's sort of the magic bullet question, which is someone asking, what is it going to take to rebalance the income distribution? Oh boy. This is, how do you pay more people without killing business, I guess is the question. And some of you talked about raising the minimum wage or attracting high-paying companies and businesses to San Diego. And then, as someone said during the break to me, the argument about unemployment insurance, all the benefits you get if you're unemployed at $50,000 is sort of a myth because that isn't really necessarily correct, and it still isn't enough to make a decent living in San Diego for a family of four. So maybe all of you have some opinion about what big and little steps companies, individuals, and governments can all do to make it fair to everybody.
I can. I'll start with that. Because manufacturing jobs pays 25 to 50% higher than service jobs. So what we need to have as a nation is a national manufacturing strategy to support our American manufacturers, and in the incentives to go offshore, bring manufacturing back to the U.S. by reshoring, because we are becoming competitive. Wages are rising in China. Fuel costs are rising for increasing shipping costs. We have the perfect opportunity now to really focus on creating those manufacturing jobs that we used to have. There's a direct correlation between the drop in manufacturing jobs and the increase of deficits at the local, state, and federal level. Because a manufacturing worker nationwide average salary is $40,000, which isn't a lot for San Diego, but it is for other parts of the country. That person, depending on the size of the family they have, is paying $3,000 to $5,000 a year in taxes. When they're unemployed, they're collecting at that salary rate $15,000 a year in unemployment benefits alone, not counting things like Medi-Cal and food stamps. So we have become a nation of tax receivers instead of taxpayers because of our offshoring of manufacturing jobs in particular.
I'll jump in next if no one else is going to go. A lot of thoughts on this. It's interesting. This is so I would just say it. John can print it. The minimum wage is going to increase. It's already a done deal in the state of California. You only have to look at the composition of our current city council in San Diego to probably think that something's happening there. You just had to listen to Mayor Gloria's State of the City the other night to see how emphatically he called for it. So I think, and I think if you look at trends, most of the people in America, most of the people in California, most of the people in San Diego, overwhelming majority think it should increase. So we can talk a lot about sort of, and I advocate for businesses for a living now, but I studied, lower wages and strategies to pull people out of poverty and worked in that world for a long time. This is a complex issue, and I think the problem is we, yet again, are sort of oversimplifying it with the messages. Giving people, giving a flat rate in San Diego of $14, $15 an hour doesn't even cover what at the Workforce Partnership we studied in 2008. 2008 said you needed $16, $26 an hour just as an individual to make ends meet in San Diego, so we're a long way from that. But I also think that just telling businesses that they have to employ people at a certain level, there's a very illogical thinking to that not having consequences on their ability to hire and grow, in addition to everything else that we've talked about already. So I think we have to think about strategies that we, in San Diego, we know help close that widening gap, because that is a very real gap in San Diego, that think about why job training programs for things like manufacturing get barely any political traction. I don't know the last time I saw a really strong politician in San Diego stand up and pound the table to say we have to be putting more funding into training our workers for just the types of programs Michelle just talked about. But that would be the one proven strategy that over time is going to get us to a place where our workforce can command and demand more money for the jobs that they're in. And I think at the same time, we have to think about the impact on businesses before we just kind of put that number out there or pay attention to one study that says that this is what it should be at for people to be able to make ends meet in San Diego. It's a complicated issue, has to be tackled by a lot of people in this room, and I think San Diego is strong enough to come up with a solution.
I'm going to have a slightly different indirect perspective on it, and that is not the income inequality per se, but some of the historic associations with income inequality, with disparities. What's beginning to happen in healthcare, and I'm saying specifically health, not medical care, is this realization of the social determinants of health, the importance of good nutrition, exercise, prevention within the workforce, emphasizing employee wellness in the schools, improving nutrition, expanding physical activity. There's this is the 50th anniversary of Johnson's declaring war on poverty. And the war on poverty was very, very broad-based in what it attacked. It was housing, it was healthcare, it was food. We're beginning to take that more holistic view again, I think. And so what you're beginning to see in the medical care community is now more attention to population health, more attention to disparities, and I think more attention to chronic conditions and how you prevent that. So I think that's one piece of it, because it can help the population in general be healthier, so that you deal with some of the things that contribute to the inequality.
We haven't heard from Joe for a bit of time, but he's the man with the money because he deals with municipal bonds and the bigger question of the capacity of government to do anything. Do you have an opinion about government's role in balancing income?
Me, Joe?
You, Joe. I'm sorry, this one.
I think a lot of very interesting and good points have been raised, and I think that manufacturing and a lot of this income disparity is the result of the middle-class economy that has been hit so hard. In California, we have so many examples of very well-to-do at the top end of the economy. There, we have a thriving high-tech and very sophisticated economies, and people are doing really well. And then we have a service economy down at the lower ends of the income levels that's there to serve them. So I think there has been, I think government role has played a part in that. A lot of it is just macro, and it was probably evolving on its own anyway. But that, not to get on any other side of a political debate, but certainly government roles with regard to land use decisions, regulation, environmental issues, employment issues as well, all have had play a part in where middle class, middle income jobs in the manufacturing center and the manufacturing sector are gravitating to. I don't think it's coincidental. You know, the areas of the country that are growing in that area. I mean, I think that California, we take solace in the fact that, you know, we grow, we innovate, we design and build systems that change the world. We do that, and we do that very well. But I also think at the governmental level, at the policy-making level of government, I mean, we really have to protect that middle too, which is so valuable. And without it, you see so much social decay. And there is a direct nexus, I think, in regulation, land use policy, tax policy, that could be changed to help lessen inequality and build overall stronger economy.
Alan or the other Joe, you want to weigh in before we wrap up here?
You know, for me, everything comes back to housing, which is, I apologize. I apologize. So, you know, you talk about I just look at who's able to afford homes and what they're making, and for me, it's, you know, we didn't talk much about rents and the you know, the rental market, but it's tough to be out there to see, you know, so many individuals. You look at the housing affordability index, I think it's at 32%, which means 32% of the population can afford to buy a medium-priced home. And you think about the other portion of that group that's out there renting, and then you see these investors coming in and driving up the market, which, you know, to buy these homes and then rent them out, and rents end up going up, and it just gets to be this vicious cycle. Yeah. And my concern obviously has to do with, you know, long-term stability in the market and whether or not these individuals can go from renting to buying, or whether that's never going to happen for them. And so, you know, for us, we look at, you know, everything that you know, we love about San Diego. There's just there's so much opportunity here. There's so much demand for so many different areas of the community. And it's just, you know, like Mark had said, I don't know what the answer is, but I know that there's going to continue to be demand for it. And I think that's good for us as a community, as long as it doesn't get too far out of hand. So,
Alan?
Sorry for being so strong about housing.
I think the classic answer to that question would be that you got to improve education. You got people more skills and knowledge to take part in this changing economy. The problem is you have to have jobs for them then when they graduate. And I think one of the problems that we're having is, again, I mentioned because of this income distribution situation, consumption. Consumption is lagging because we're not having that middle class going out there and spending money on restaurant meals and retail and vacations and things like that. I don't know if there's anything that can be done about this, but I think one of the big causes of income inequality has recently, in the last couple of decades, has been the vast rewards that go to finance. Not only people working in finance, but the fact that compensation, a lot of corporations now, is based on stock options and things like that. That has some implications for the economy. You know, there's this complaint in this country that we just don't have enough people in STEM, you know, science, technology, engineering, and math. When the CEO was making like 20 times what the average worker made, you know, okay, you go into engineering. But now when the average CEO is making 400 times what an engineer makes, you know, why go through calculus and physics and chemistry when you can go into finance? And even though I'm in the School of Business and I'm going to teach investment economics in the spring, we just got too many people, I think, in that area. I'm not sure though if you know what can be done about that. And I think one last thing in terms of helping the situation is that I don't think that we got to stop treating labor as the bad guy.
Yes.
I was going to put a chart in my presentation that compared unionization with the middle class share of income. There's almost a direct correlation in the decline of both, but it would have made me more leftist than my presentation already was. But right now, again, a lot of downward pressure in terms of labor, and that has impacted a lot of people in the middle and the bottom.
Well, there were a lot of great questions from the audience that we didn't get to, and we appreciate you all filling those out. Roger and I often ponder, are we better off this year, or are we going to be better off this year than last year? We wondered, like, what's the new normal? Last year was like, like for the last couple of years, you're going to have slow growth. The job market is going to be tough. It sounds like there are little bits and pieces of the economy that are starting to recover more quickly, but I guess we were asking, what's the new normal? And is it bumping along the bottom? I don't want to say the bottom, but just kind of bumping along, having, one month a job report up, another down. The same with housing, mortgage rates creeping up a little bit, sales, things pitching back and forth. And so I guess I want to ask you again, the audience, are you feeling like 2014 is going to be better for you? We just heard about income inequality, long-term stability. How are people feeling? Better this year? About the same? It's about better this year. Okay, ooh.
25%.
Okay, about the same. A lot, okay. Worse. Okay, it's okay if you say it's worse. Yeah. Okay, it's an unscientific poll, but it does kind of help us, and make sure you're still awake out there. And we hope you'll join us next year for the event. It's always fun for us, and we appreciate you coming. Thank you.